Welcome to Acera's pre-retirement webinar. In this webinar, I'm going to tell you all the things that you might want to know in the 3 years leading up to retirement, or maybe even the 3 months or 3 weeks leading up to retirement, because you're going to retire soon and you probably have some questions. Questions like, what do I need to know? What do I need to do, if anything? Well, I have been doing this for a while. I think I know maybe about 95% of the questions that you're going to ask, and I've arranged the answers to your questions into the form of this checklist that we're going to go through during this presentation. So first off, I'm going to help you understand a little bit about your SARA membership. We'll talk briefly about contributions, your retirement timeline, and your tier. So that'll go by pretty quick. The next part of the presentation is going to be the meat of the first part of the presentation, estimating your future retirement benefit from Acera. We'll talk about the retirement formula. We'll talk a little bit about purchasing service credit. We'll talk at length at how vacation affects the salary component of the formula. And then I'll show you our benefit estimator tool and how to use that. I will also help you verify your retirement eligibility. I'll talk about the process of choosing your retirement date because it's a date that you choose. We do not choose it for you. I will talk about the process of applying to retire. And then we'll talk about the five retirement allowance options that you're going to choose from on your retirement application. I will also talk about other benefits, including medical, dental, vision, and some other life events. And that'll take up about 3 hours and 15 minutes. So let's jump right in. Okay, let me help you understand your Acera membership. Who is Acera? Acera, in one sense, is this acronym that stands for the Alameda County Employees Retirement Association, but it's made up of a lot of people. There's about 92 of us that work at Acera, and our entire job is to provide retirement, disability, and death benefits to our members. That is you. You are part of the who that is Acera, because you are a member of Acera. And you're a member of Acera because of the position that you work in and who you work for. So at some point, either currently or in the past, you worked full time. And that full time was in a retirement eligible position for one of the six public agencies in Alameda County that use Acera to provide retirement benefits to their employees. So if you work for one of these six employers in that retirement eligible position and you started out full time, you don't have to continue full time later to maintain your membership, but you started out full time, that automatically made you an Acera member. And your membership is mandatory and automatic. And as an Acera member, you pay into Acera's fund with every single paycheck that you receive. So if you look at your paycheck in the before tax deductions area, you'll see a line. It probably says something like retirement or Acera. And you'll see some money coming out of your check on a pre-tax basis before tax deductions, and that goes into Acera's fund. And every time that happens, your employer also makes a contribution on your behalf. So you're both contributing to Acera's fund, and we don't want this money to just sit around and collect dust, so we invest it all over the world in a diverse array of investments with the goal of earning interest, which we if you annualize our return over the last, however many years, we can make consistent investment earnings over time. And it's these three sources of income that provide us this big pool of money that we call Acera's fund. So why are we collecting all of this money? Well, we need the money because you, as an Acera member working in your Acera covered position for your participating Acera employer, as you work throughout your career, you earn more and more credit toward retirement. And then at some point in the future, which is probably why you're watching this presentation, you are planning to retire. You will retire from Acera. And at that point, you stop earning credit toward retirement and you start collecting on the retirement that you've been earning throughout your entire career. And your retirement comes in the form of a monthly retirement allowance for life. So this is a payment that you're going to receive from Acera through direct deposit. The first one is a live check, but then everyone after that is direct deposit that you're going to receive on the last business day of the month, every month for the rest of your life. You cannot outlive your Acera retirement allowance. It's a really beautiful thing. It's a guaranteed amount of money that you can predict in the future by using our benefit estimator in your member direct account, and you can count on for the rest of your life. Now, you'll see me throw around some other synonyms probably throughout the presentation for this retirement allowance, like pension, pension benefit, retirement benefit, pension allowance, retirement allowance. These are all synonymous terms for the same concept that you have earned this payment for the rest of your life because you deferred some of your wages and we invested it for you and we pooled all of that money so that we can plan for your future. Okay, and somebody's asking, I know what I contribute, but how can I find out how much my employer contributes? So if you visit acera.org/contributions and you scroll all the way to the bottom of the page, there will be a link for the employer contribution page, and you can see what they contribute. And it's usually because our funded rate is currently lower than 100%. They're contributing more than you're contributing kind of as catch-up payments so that we can get back up to 100% because they have to by law. Okay, so let me show you some pension milestones. These are some milestones that you will see throughout your career with Acera, throughout your career with your Acera participating employer. The first milestone is your date of hire. This is your first day in your full-time retirement eligible position. This is, if you started out in that full-time retirement eligible position, this would be the first day that they told you to show up to work. If you started out in some other capacity, like part-time, this would be the first day that you worked in the full-time retirement eligible position. Okay, then for 4 of our employers, 2 weeks goes by and you have the first day of your second pay period. And that becomes your date of entry into Acera. And this is your first day of Acera membership. This is the day that you start earning credit toward retirement. Now, 2 of our employers, Livermore Area Recreation and Park District and the Housing Authority, there's no lag time. The first day of your full-time retirement eligible position is your date of entry into Acera. Okay, now you're an Acera member. What happens? Well, you start working, you start earning credit toward retirement, and you earn credit toward retirement in 3 different categories, which I'll talk about in just a few minutes when I show you the retirement formula. One of the main categories that people look at is called service credit. It's basically years worked. So if you earn 5 years of service credit by working 5 years full time, or the equivalent of 5 years full time, you're considered vested in the retirement system. Investing is a little bit of a loose concept. It kind of means that you're guaranteed, like you can start accessing the guaranteed benefits. You're vested in the system. The vested benefits are guaranteed benefits. Okay. So, so at 5 years, you can kind of start being able to access some of the benefits. You'll see what I mean when we talk about the retirement eligibility requirements. Okay, so once you're vested in the system with 5 years, then some other indeterminate amount of time transpires. And through some combination of your years of service credit and your age, you become eligible to retire. Now, there's a few different combinations. I'll show you what they are in the second half of the presentation, but this is the first day that you are physically able to retire from Acera if you choose. Now, many people do not choose to retire on this day. Many people choose to continue working past their first day of retirement eligibility in order to earn more and more credit toward retirement to maximize that monthly payment that they're going to get when they retire. And so at some point after you're eligible to retire, you have your retirement date. But actually, we haven't gotten there yet. We have one more day to do, which is your date that you leave employment. This is your termination date or your last day on payroll. And this is the day that you stop earning credit toward retirement. And then for many people, if you go straight into retirement, the very next calendar day is your first day of retirement. And this is the date that you choose. Okay. So some of you may not go straight into retirement. There may be a gap between these 2 days, and that's totally fine. You can stop working for your employer and defer your retirement to a later date and become what we call a deferred member. And I'll talk a little bit about that a little bit later. But that's totally fine. Now, so now you are retired. You chose your retirement date. This is the day that you start earning your lifetime monthly retirement allowance. and you start collecting it. I'm sorry, this is the you start collecting it. You've already earned it. And you're going to collect it every month until your death. That's when your retirement payments stop. But there is one more milestone on the milestone chart, which is because at the time of retirement on your retirement application, you can designate a beneficiary. That's somebody who gets benefits to get a continuance benefit, which is a continuing monthly payment after your death. So if your beneficiary survives you, you die first, then your beneficiary would receive continuing payments until their death in most cases. Um, and so that is when that would conclude Acera paying out all of the benefits that we owe to you and your family. Okay, now let me talk about this worksheet. This is kind of a bonus thing that we provide. You don't have to do this. If you're taking notes, you can just take notes on your, notepad or whatever. But what I've discovered is that there's a lot of numbers I throw out at you, and there's a lot of personalized numbers for you that you learn through the course of the presentation. So this is just a handy place to record all the numbers that you learn. The shortcut to get there is acera.org/worksheet. I can show you how to navigate there on our website. If you go to acera.org and you go under news and events and you go down to the option retirement planning seminars, click on that. And then you can see there's two options. You're in the pre-retirement webinar right now. And if you do want the pre-retirement seminar handout, that's available right here. Just a quick note, I did make a few updates to it right before I got on this. So I'll upload the updated version directly after the presentation if you want to download it after the presentation. And then you have the retirement planning worksheet here. So this is a PDF. It's 2 pages. You can download it. I recommend if you're going to fill it out, you go ahead and download it to your device, and that way you can save your changes because it is electronically fillable. Um, and it's just a place to record, the numbers that you learn here. But like I said, it's purely optional. I will be referring it to it throughout the presentation just in case you do want to fill it out. Um, and just, to make note of the different numbers that you might want to write down. And then there's a question up on the Q&A. Will you cover who is allowed to be a beneficiary? Absolutely. I go into that in great detail, and that's when we talk about the 5 retirement allowance options. Absolutely. And I will definitely make sure you understand all of that. Okay, so right now at this point in the presentation, if you have if you know your Acera entry date, or it says approximate dates, you can kind of get close. If you want to happen to write that down, you can do it. If you don't remember what it is, but you remember it was like November of 2001, you can just write that in. If you do want to know your exact Acera entry date, you can log into your Member Direct account on our website, and it will tell you exactly what your Acera entry date is. And also at this point, if you have a projected retirement date in mind, you can pencil that in. But you may learn something because we're going to cover choosing your retirement date. There may be something you learn that may make you want to adjust your date by a few days here or there. Okay. And then just a couple more bullet points about vesting. I said that it happens with 5 years of service credit. That includes reciprocal service credit if you have reciprocity with another retirement system in California where you've linked the systems together. It's the 5 years of service credit combined among all the systems that are linked. Gets you over the vesting requirement. And the guarantee, I said vesting means guaranteed. The guarantee is by state law. State law governs everything that we do. And the guaranteed benefits are that monthly retirement allowance, retirement benefit that you'll get every month for the rest of your life, an annual cost of living increase, that's a percentage increase in retirement every year to your retirement allowance, and a $1,000 lump sum death benefit. Now, there's other death benefits available depending on which retirement option you choose, and I'll talk about those in the second half of the presentation. And I'll also go into detail about how the cost of living adjustment works and how that's calculated. Okay, so if you want to record your vested date, it's not super important. If you already know you're well past 5 years, you don't even have to worry about it. But if you happen to want to write down your vested date, you just take your entry date and add 5 years. Okay, now let me tell you about your tier. Some of you probably know which tier you're in. Some of you may not know. Some of you may not know how it even works. The way the tiers work, you're all in one of these tiers, and you go into a specific tier when you enter Sarah because of the date that you enter a Sarah. So if you had entered a Sarah before the cutoff date at the end of each tier, that would put you in the earlier tier. Now, to figure out which timeline to look at here, first off, if you're a safety member, you're going to look at the bottom one. Safety members are sheriff's deputies and probation officers, and there's possibly some other sworn officers that I'm unaware of. So you're looking at the bottom timeline. Anyone who's not a safety member is a general member. And so you're looking at the top timeline, unless you're a general member who works for the Housing Authority or a general member who works for Livermore Area Recreation and Park District, and then you look at the timeline for your employer. Okay, so if you entered, the way this works is if you entered as Sarah before July 1st, 1983, as a general member, that would have put you in Tier 1. If you entered as Sarah July 1st, 1983, all the way up to December 31st, 2012, that would have put you in Tier 2. If you entered as Sarah January 1st, 2013 and beyond, that puts you in Tier 4. And that is true for all of the timelines in all situations. Now you'll notice Housing Authority has a different Tier 1 cutoff. LARPD has a Tier 3 that they installed, that they introduced for their employees. They don't have a Tier 2, and there's a different Tier 1 cutoff. Safety members have 3 different Tier 2s. And if you entered a Sarah between October 17, 2010 and December 31st, 2012, you had the choice between these two Tier 2s, Tier 2C and Tier 2D, that you had to make within 45 days of your safety membership. And if you didn't make a choice, you were defaulted into whatever the lower tier was. Okay, now just one more thing about the tiers. People ask, why are there tiers? Well, there's a little bit, there's differences between the tiers in how we calculate your retirement. And you'll see that as we go through the presentation, I'll note which rules apply to which tiers. Okay. Oh, and if you do want to see which tier you're in, like you don't remember your Sarah entry date or you don't know what tier you're in, again, you can always log into your account on our website. All you do is you go to sarah.org to log into your account. And at the top of every page in the header, there's a login button, and you can just click the login button and it will get you to the login page to log into your account. And if you've never logged in before, let me just walk you through that real fast. First of all, you're going to have to enroll in Member Direct. If you used to access our old member portal, Web Member Services, we replaced that a year ago. So if you haven't been in here in a year, and we sent everybody a letter with a PIN, you didn't take advantage of the PIN letter that we sent you, you're going to have to request a PIN. So you click the enroll button, you request an enrollment PIN, and then you fill out your info and hit request PIN, and you'll get a letter in the mail in a few days with your PIN. And then you come back to the enrollment page, you use your PIN here, and then you fill out your info, you create your username and email, and create some security questions and hit enroll. And then every time after that you come back, you just need to use your username and password to get in there. Okay. At this point, if you want to write down which tier you're in or mark it on your worksheet, you can feel free to do that. And let's move into the next section, estimating your retirement benefit. Okay. At the end of this section, I'm going to walk you through some screenshots of our benefit estimator. But before I do that, I want you to understand our pension formula. And that will help you understand how we arrive at your pension estimate, how we calculate your final retirement when you retire, and it may help you figure out how to dial in this monthly retirement allowance and make sure it's the maximum that you can get. Okay, because there's a few different caveats that you're going to want to consider. Okay, so let me explain the formula first off, how we calculate your retirement. Okay, as an ACERA member, when you go to retire, your monthly retirement allowance that you're going to receive for the rest of your life from ACERA is going to be a percentage of your highest salary that you earn at any point in your career. So you're going to get a percentage of that highest salary for each individual year of service that you work. Okay. Now, this sentence is telling you in English what this um, formula is doing. Okay. So let's say, for example, let me put some numbers in here and I think it'll help illustrate this better. Let's say, for example, that the percentage of your highest salary that you are going to get for each year of service is 2%. Okay. And that's the age factor percentage part of the formula. Okay, so let's say your age factor percentage is 2%. That's the percent of your highest salary you're going to get for each year of service. And let's also say that at the time that you retire, when we go to calculate your retirement, you have earned exactly 20 years of service credit. Okay, what that means is that you're going to get 2% of your highest salary for each individual one of those 20 years that you worked. Okay. Basically, the formula is going to take the 2% of your salary and we're going to add it up 20 times. We're going to add 20 of those together. And that's going to equal 40%. Because essentially, when we do that, when we add 2% over 20 times, we're multiplying these together. 2% times 20 is 40%. Okay. So now we know your monthly retirement allowance is going to be 40% of your highest average monthly salary. So just to finish out the example, let's say your highest average monthly salary before you retire is $5,000. So you were earning an average of $5,000 per month during your highest period of pay, which I'll talk about later. We'll go into detail about that. That means that your retirement allowance is going to be 40% of $5,000, which is $2,000 to finish out the multiplication. Okay. So the bottom line there is that because this is a multiplication, the higher any of these factors are, the age factor percentage, the service credit, or the highest average monthly salary equals a higher monthly retirement allowance for life. So the way to dial in your retirement allowance, you don't have a lot of latitude to do this, but there are some ways kind of around the edges that you can dial these three numbers in. Okay. And these are the three categories that you're earning credit toward retirement. That I was saying before, that you earn credit toward retirement throughout your career. You earn credit in the age factor percentage category by getting older, and you'll see in a minute, the older you are, the higher the percentage. You earn credit in the service credit category by simply working longer. You work 20 years, you earn 20 years of service credit. You work 20 and a half years, you earn 20.5 years of service credit. It's measured in years, and you get all of the partial years in the formula for you. And you earn credit toward retirement in the salary category by making higher and higher salaries, but through cost of living increases and raises and perhaps promotions throughout your career. Okay. Let me tell you about each one of these factors in a little more detail, and I think that will help you figure out where those places are on the edges of these that you can dial these in. Okay, first off, the age factor percentage. The way this works is there is this chart of age factor percentages. There's a set of age factor percentages for each tier. And what you're seeing here is a sample of some of those percentages. This is a sample age factor percentage chart for this example. So what you're going to do is you're going to find your tier on the chart, okay? And you ignore all the other tiers. So for example, if you're a general tier 2 member, you're just looking at this column, this set of age factor percentages. None of the other ones apply to you. If you're a safety member, you're going to look over on this side, okay? Now, when you go to retire, what our software is going to do is that it has all these percentages programmed in. It's going to look at your age at retirement and your tier, and it's going to choose the percentage that, where those intersect. So if you retire at age 60 as a general tier 2 member, your age factor percentage is going to be 1.92%. So this would be the number that we plug into the formula for you. You would get 1.92% of your highest salary for each year of service. Now you'll note that the numbers get bigger the older you are when you retire. So that is like one way you're kind of earning credit toward retirement by simply getting older. And you'll note that there is also a maximum age factor percentage for each tier that is denoted in the blue box. So for example, general tier 2 members, the maximum age factor percentage you can get is 2.43% at age 65. If you retired at age 66 or 67 or 77, you would still get the 2.43% maximum. So at the maximum age for your tier, the percentages stop increasing, but they will increase all the way up until that maximum age. And in fact, they increase every quarter year. Okay. So they increase every 3 months and it's based on your birthday. So, for example, if your birthday is January 15th, 1 quarter after your birthday would be April 15th. 2 quarters after your birthday would be July 15th. 3 quarters after your birthday would be October 15th. And then back to your January 15th birthday. So every time you pass one of those quarter year dates, you go up one notch in this age factor percentage chart, and there's actually an incremental increase for every quarter year. If this were the full chart, this would actually say 50, 50 and a quarter, 50 and a half, 50 and 3 quarters, 51, and so on and so forth. But I don't put them on all. I don't put all of them on here because they don't all fit on the slide. But if you do want to see all the incremental age factor percentage increases, we do have them out on our website. So the way to dial this one in is to just, basically not retire right before your age factor percentage goes up, because you get a slight increase to your age factor percentage just by making sure you get past whatever the next age factor percentage increase is. So that's how the age factor percentages work. Service credit. Let me tell you all about service credit. So you start earning service credit when you enter Acera, and you will earn service credit throughout your career as you work all the way up until you leave employment, until you terminate your employment. And you're earning credit, service credit. Service credit is measured in years, but you're actually earning service credit down to the fraction of a day. Every 15 minutes you work, you earn 15 minutes of service credit. And if you look at your service credit number when you log into your account, it'll have a bunch of decimal places after it. It'll say like 15.87265. And all of those decimal places are calculating your service credit down to the fraction of a day, and you get all those decimal places in the formula. So you earn service credit right up until the last 15 minutes on your last day on payroll. You earn service credit during your regular work hours. You also earn service credit during your earned leave times, and that includes vacation leave, sick leave, if you get management leave, if you get comp time, holidays, and floating holidays. You earn service credit during all of those times when you mark them on your timesheet. Those do not count against you for earning service credit with Acera. Now, you do not earn service credit anytime you're on leave without pay. You're not earning service credit. If you purchase additional vacation, so some of our employers allow that, it's extra vacation that you buy so that you have more vacation than just what you earn. When you go out on a purchased vacation and you mark the purchased vacation on your timesheet, you're not earning service credit during that time. Also, if you sell your vacation, this is a different concept than purchasing. Selling vacation is when you take your earned vacation that your employer provides you as one of your benefits, and you sell it back to them for cash. You don't go out on the vacation, you just sell it back for cash. You don't get earned service credit for that transaction. However, you may earn salary credit in the salary component of the formula for that transaction, and I'll talk at length about that when I talk about the salary. You also do not earn service credit during overtime, on-call time, or standby time. Okay, now I'm just going to touch on this briefly because I find that most of the people who are getting ready to retire have already purchased the service credit, but if you haven't, you may want to explore this topic a little bit further. I just want to tell you about this in case you haven't heard about it, but this could be one of the ways to dial in the service credit. The very first way to dial in service credit is to work longer, earn more service credit. But there's this additional way, which is to purchase additional service credit if you have time eligible to purchase. You can't just purchase airtime, just time out of thin air, like extra time, but you can purchase some of these types of time. Basically, what these are a type of time where the law did not allow for you to earn service credit during that time, but it does allow for you to go back and purchase it later. And that would include things like part-time work for your employer before you got your full-time retirement eligible position. There's some other categories that are similar, like intermittent um, work, um, seasonal work, project work. These are purchasable. The things that aren't purchasable in this category are if you worked for an employment agency or a temp agency, that's not purchasable. That was for a different employer. Also, if you worked under contract, that's not purchasable. Okay. Or if you worked in the county's temporary assignment pool, that is purchasable. There's a full list out on our website at acera.org/purchase. Also, the 2 week lag time between your entry date and your hire date is purchasable if you had a 2 week lag. Unpaid leave, including medical leave, disability leave, and military leave. When you return from the unpaid leave, you can purchase that time. The medical leave has a cap of a year per instance of medical leave. Redeposit of prior memberships. That's where you used to be an Acera member in the past. You quit your job or you left work in some capacity. And when you did that, you took a refund of your Acera contribution account and canceled your Acera membership. But then you come back to work for one of our employers later. You become an Acera member again. You can put that money back and get your service credit back from that original membership. And that's a redeposit of prior membership. Redeposits of community property. This is where you were married or you were in a state registered domestic partnership while you were earning credit with Acera. And because California is a community property state, your Acera retirement account was one of the pieces of community property that was up for division when you did the settlement. And often what will happen is the ex-spouse will get like a piece of your account. They'll take a piece of your service credit and a proportional amount of your employee contributions with them to their account. If they take a refund of their account, then we will send you a letter in the mail letting you know about that and give you an opportunity to redeposit an equivalent amount of money to get that service credit back that they took with them. And that's a redeposit of community property. And then if you used to work for another California public agency and it's not a reciprocal agency, like you don't have reciprocity with them, it's just like you used to work there and you're not eligible for their pension, you can, in many cases, buy that time as a Acera service credit. So like I said, I'm not going to take a deep dive into this topic, but you can read more at acera.org/purchase. The one additional topic regarding service credit I am going to talk about is what happens to your unused sick leave. Okay. So if your plan is to go straight from active work into retirement, you're going to stop working for your employer and you're going to retire immediately. Acera will convert your unused sick leave to service credit on a 2-to-1 basis. Okay. So what I mean is, and when I say you're going straight into um, retirement from active work, that means that your last day on payroll is the calendar day before your Acera retirement date. These are 2 consecutive calendar days, so there's no gap in between them where you are a deferred member. You're not deferring your retirement even one day. So if you're going straight from active work into retirement, we convert your sick leave on a 2-to-1 basis to service credit up to a cap. Okay, there's a maximum amount. And the cap is noted in your memorandum of understanding for your bargaining unit. So that's what MOU stands for, Memorandum of Understanding. So you have to look at your MOU to see what the cap is. Many of the bargaining units, the cap is 125 days of sick leave. So if you were in one of those bargaining units, I'll just do that one as an example. Then let's say you had 130 days of sick leave on the books when you stopped working and went straight into retirement. Sarah would see in your payroll records you have that 130 days of sick leave, so we have to chop it off at the cap. So then we're looking at 125 days of sick leave that's convertible. You just lose that extra 5 days. And then we'll take what's remaining up to the cap and divide it by 2 and give you that additional service credit in the formula for you. So if you had 125 days of sick leave, we divide it in half, that would convert down to 62 and a half days of additional service credit. Now that is not calendar days, that's work days. And 62 and a half work days equals a little over 12 work weeks, which is about a quarter year. So if you were in that scenario, you would get an additional 0.25 years of service credit, approximately, in the formula for you, and that's another way that your service credit gets dialed up. Now, doing this conversion does not push your retirement date out. It has no effect on what your retirement date is. Your retirement date is your retirement date, and that's your first day of retirement when you start collecting your pension. All this affects is the amount of service credit we put in the formula for you when we're calculating your retirement. And the other thing I wanted to say about this is that I'll think of it in a second. But I will also say that if you become a deferred member, if you spend any time as a deferred member, which means you stop working and you retire on a later date, so those retirement date and last day on payroll are not consecutive calendar days, then you just lose all your sick leave. Oh yeah, I remember what I wanted to say. The conversion to service sick leave to service credit, it happens automatically. You don't have to request it. You don't have to do anything. We just do it for you. Okay, I see some questions have popped up, so let me go ahead and answer the questions, or look at the questions anyway. So somebody had a question about the tiers. So the question is, for the age factor, the max is 2.43% for age 68 and beyond tier 2 general member. The 2.43% actually starts at age 65. So if you retire at age 65 or older than age 65, no matter how old you are when you retire, your age factor percentage as a general tier 2 member would be 2.43% in the retirement formula. Okay, and somebody's asking about PTO regarding the sick leave. Okay, thanks for that question. So my assumption when you say PTO is that you work for Alameda Health System because I think they're the only one of our 6 employers that does the PTO. And for the rest of you, just a quick note, Alameda Health System pays out. It's kind of like sick leave and vacation leave in one bucket called paid time off. I think PTO. So the PTO is not convertible to additional service credit. There are some other leave times including I think intermittent sick leave and extended sick leave. If you have leave balances there, we will convert that to service credit. But PTO is not convertible to service credit. However, with the PTO, you will be able to get salary credit for it if you have PTO on the books, which is actually a little bit better. So I'll show you how that works when I talk about the salary component of the formula. And then let me see, last question up here. You receive service credit. Okay, so the question is, I will receive service credit for 62 and a half days extra beyond the date that I retire. Sort of. I mean, that's one way to think about it. Yeah. If you're in the if we were converting 125 days of unused sick leave that you had on the books when you retired, yes, you would get 62 and a half extra work days kind of beyond your retirement date as service credit. So that is one way to think about it. But if you didn't have 125 days on the books, if you had only 100 days, then you would get 50 days of service credit. If you had 50 days, you'd get 25 days of extra service credit. So it's whatever you have on the books divided by 2, but again, up to your cap and your memorandum of understanding. Okay, so there's a question up on the board regarding service credit. It sounds like you joined Acera January 2023, left in 2025, came back in 2012. Are both of those considered in determining service credit? Well, it depends. When you left in 2025, did you take a refund of your contribution account at that point? If you did not, if you just left it with Acera and then you came back and started working again in 2012, yes, that 2 years or whatever it was between 2023 and 2025, that amount of service credit would automatically get included when we calculate your service credit. If back in 2005 when you left, you did take a refund of your contribution account, that means you lost that service credit from that original membership with Acera, but you can purchase that service credit again. That's a redeposit of a prior membership. And if you want more info on that, you should visit acera.org/purchase. And if anyone who's going to make a service credit purchase, you need to make it before you retire. That's the cutoff. That's the deadline for making service credit purchases. Okay, we talked about the age factor percentage. We talked about the years of service credit. Let me tell you how we calculate your highest average monthly salary. And somebody's asking, will you cover what happens to unused vacation time? That's perfect timing because that's exactly what I'm going to cover right now. Okay, so how do we calculate this final factor in the three-factor retirement formula? Highest average monthly salary. Well, here's the way this works. When you go to retire, and we need to do this calculation, our software will find, based on your payroll records, because we have them all in our database, because your employer transmits them to us so we can do these calculations. Based on your payroll records, our software will find what is called your final compensation period, which is your period of highest pay from any point in your career. It's the time of consecutive pay that you are getting paid the highest amount anywhere in your career. Now, if you're in tiers 1 and 3, this is one of the differences between the tiers. If you're in tiers 1 and 3, your final compensation period is going to be your highest consecutive 26 biweekly or 12 monthly pay periods, depending on how you're paid. If you're in tiers 2 and 4, your final compensation period is going to be your highest consecutive 78 biweekly or 36 monthly pay periods. Essentially, for tiers 1 and 3, it's your highest year of pay. And for tiers 2 and 4, it's your highest 3 years of consecutive pay. So then, so once our software finds your final compensation period, your period of your highest consecutive pay, what we need to do then is determine your average salary during that time. So all it does is it takes your total pay over that highest year or highest 3 years, and it divides it by the number of months, because we're looking for a highest average monthly salary. It divides it by the number of months in that period, and that becomes your highest average monthly salary. And that we take that number and we plug it into the formula, multiply it by the other two factors, and that gives us your pension for life. So, what types of pay are going to be considered in this calculation? So, the types of pay, there's 4 different types of pay, and this is all gross pay before any deductions are taken out, okay? The types of pay that are included in the calculation are, of course, your base pay. That makes sense, the bulk of your pay. But there may be some other pay codes in there. Sometimes these are called footnotes. Some of these count, some of these don't. And there's like 1,000 of them. So if you want to figure out whether your pay code counts, if you have other pay codes, you can go to acera.org/paycodes, and we have lists there based on employers, and you can find your pay code on there, and it'll say yes or no whether it counts for calculating your highest average salary or not. The one pay code I do know never counts is overtime. And somebody's asking, how does retro pay figure into the year of pay? Good question. Okay, so by retro pay, I'm imagining you mean that there's bargaining going on. And then at the end of the bargaining for your bargaining unit, it is decided that you are going to be paid retro pay back to a certain date because that was the contract was up and you should have been, based on the final um, contract, you would have been making more money during that time, so they pay you retro pay. Let me think about that. It's a good question. My I'm gonna take a guess. What I think that you should do is contact my colleagues. If you if you call I'll type the number in here. If you call 510-628-3000, that's our member services number. During business hours, we have multiple people in there. Their entire job is just to answer your questions about your pension and how it's calculated, how you can plan for it. So 510-628-3000. You can also email us by logging into your member direct account and going to the message center in there. We are starting about a month ago. We started requiring members email us in there because it's more secure. So you got to go. The shortcut to get there is acera.org/email, and it'll take you right to the message center. But you will have to log in first. And that's the way you can ask us questions by email. But my guess is it probably counts as long as you're paid the retro pay, as long as you're actually paid the retro pay before you retire. Like if it shows up in your paycheck, my guess is that it's probably going to be counted. But again, I would check with my colleagues on that because I'm not entirely sure about that. Okay, so we covered the first two types of pay that's included in the final average salary calculation. There's two more. Now these apply to tier one and tier two. Okay. They don't apply to tier three because LARPD doesn't let you sell vacation. And based on the strange rules around this whole concept, it doesn't allow you to, it doesn't allow us to include any extra vacation sales or cash out pay in your salary. For tier four, the law disallows that the law that created tier four that began, that was passed in 2012. Okay, so tiers one and two. Some vacation sales, and some vacation cash out can be included as salary for the purposes of calculating your retirement. So, tier three and four members, you can take a little optional break. We're probably going to talk about this for 10, 15 minutes, or you could stick around if you're curious. Okay, so here's how this whole concept works. If you're in tiers one and two, and you're earning vacation, right? Everyone's earning vacation. Um, and when I'm saying vacation, I'm also talking to the Alameda Health System people. You're earning PTO, okay? So that's included in here. You're earning this, and your employer allows you to sell some of that vacation, okay, back to them. That's called a vacation sale. This happens while you're still employed, okay? A vacation cash out is when you have vacation left over on the books when you stop working and retire. We're, let's assume that you're going straight into retirement, but it's not necessarily necessary that you're going straight into retirement. It's just when you stop working. You have vacation on the books that you haven't taken yet, and they will write you a check for that, or they will include extra money for that in your final check. That is called a vacation cash out or a vacation payoff. Okay. So if you sell vacation during that final compensation period, that period of highest pay in your career, or you cash out vacation and your final compensation period is at the end of your career, that it is in the vast majority of cases because the vast majority of people are making the highest rate of pay at the end of their career. That is the vacation compensation that we're looking at when we're talking about this concept. But the sum of these two amounts would be your total vacation compensation during that time. Okay. So, and we're only looking at vacation compensation that you were paid during the final compensation period when we're talking about this topic. If you sold vacation, a long time ago, we don't care about that. We're only talking about what you sold during the final compensation period or what was cashed out during the final compensation period. So the idea here is that if you are compensated for your earned vacation that you're not going to take during that final compensation period, that means that when our software calculates your total salary during that final compensation period is slightly higher. It's a little bit bigger because that compensation by law is considered salary. Because your total salary during the final compensation period is a little bit bigger, when our software calculates your average monthly salary is a little bit bigger. Because the average monthly salary is one of the three multipliers in the retirement formula, and the higher those numbers are, the higher your retirement allowance is, your retirement allowance gets a little bit higher. So the bottom line here is that if you are compensated for your earned vacation during that final compensation period, that increases your retirement allowance by a little bit. And when I say a little bit, how much do I mean? Well, here's an approximation. This isn't exact, but this is approximately how much it increases it, okay? So if you're in tier two, for example, and Acera is able to include 6 weeks of your earned vacation that you are compensated for either through a combination of sales or cash out, either or both. We're looking at the combined amount, and the combined amount is 6 weeks, and you're in tier two, that would increase your retirement allowance by 3.8% immediately upon retirement. When we calculate your retirement allowance, it's baked into the calculation. So your retirement allowance starts out 3% higher, 3.8% higher than it would have been, and it remains higher throughout the rest of your life. Okay, so you can see why people are interested in this topic because it does increase your retirement allowance by a little bit immediately and for the rest of your life. And you can see that the more vacation compensation that is included in the salary calculation, the higher that increase effect gets upon retirement for the rest of your life. You'll note also that for tier one, the increase effect is accelerated, and that is due to the 1 year final compensation period. Okay, now there is a cap on how much vacation compensation Acera can include as salary for the purposes of calculating your retirement. Now you'll note I said can, but the slide says must include. And the reason I say must on the slide is because this is how the law tells us to calculate your retirement. Um, there's there are people in the world that have an opinion about this, and it doesn't matter because this is the way the law tells us to calculate it, so we have to calculate it this way. And because we have to calculate it this way, I should tell you exactly how it works. I feel it's my responsibility to tell you exactly how we do the retirement calculation. So I'm going to talk to you about the cap on what the maximum amount of vacation compensation is that Acera can include in your salary calculation for calculating your retirement. The first people I'm going to talk to are Alameda Health System employees, okay, and then I'll do everyone else second. Okay, now you'll note what you're seeing here is a piece of that retirement planning worksheet that is kind of the companion worksheet to this webinar. And if you want to get that, it's a PDF. It's at acera.org/worksheet. So if you're an Alameda Health System employee, to figure out the maximum amount of vacation compensation Acera can include as salary for calculating your retirement, all you need to know is one single number, and that is how much PTO you earn per pay period. And I believe it tells you that on your pay stub. So if you look at your pay stub, you see how much you earn per pay period, you plug that number in here. Okay. In this example, this person earns 6.7692 hours of PTO per pay period. Okay, now what you do is if you're in tier one, you multiply that number by 13, and that tells you your limit in hours. If you're in tier two, you multiply that number by 39, and that tells you your limit in hours for tier two. Okay. So whatever the equation ends up with, that is the maximum amount of hours of PTO that you are compensated for that would increase your retirement allowance because we have to consider that as salary. That is your salary that you earned. It's considered salary for calculating your pension. Okay. So for Alameda Health System people, all you need to do is have, this much or at least this much on the books when you stop working, and that would maximize. And when I say this much, I mean you got to do the math. This is just an example. But if this was the amount of PTO that you earned and you were in tier two, 264 hours of PTO would be the maximum amount that we were able to convert that we were able to consider as salary for calculating your retirement. So you would just have that amount or more on the books, or up to whatever you can. If you've already taken a lot of vacation and you have less than that, it doesn't matter. We'll include all of it if it's less than this. Every little bit helps. Okay. Now the exception for Alameda Health System employees is if you're in the UAPD union. You don't have to do any math. If you're in tier one, your cap is 120 hours. And if you're in tier two, your cap is 360 hours. So no multiplication necessary. Okay, so that's Alameda Health System. Now I'm going to do everyone else who is in tiers one and two and is allowed to sell vacation. And I think, let me just verify who that includes real fast. That's Alameda County, the courts, and the housing authority. Because LARPD can't do it. We already talked about Alameda Health System. And I think first five, for some reason, you can't do it. But I could be wrong about that. Okay, anyway, everyone else. This is also a section on that worksheet. You need to know two numbers in order to figure out what's your cap on vacation compensation that's includable as salary for calculating your retirement. You need to know how much vacation you earn per year, and it's measured in weeks. So you earn 2 weeks or 3 weeks or 4 weeks, okay? You plug that into the worksheet here. This person earns 5 weeks of vacation per year. It's based on seniority. I think you have to have worked for at least 21 years to get up to 5 weeks. Okay. You also need to know how much vacation you're allowed to sell if you wanted to sell it. You don't actually physically have to sell it, you just need to be allowed to sell it. And the limit is somewhere in your employer's handbook or in their set of rules. If you don't know how much you're allowed to sell per year, you can ask your payroll clerk or human resources. They usually know. Okay. In this example, this person is allowed to sell 2 weeks of their 5 earned weeks back to their employer for cash if they want to per year. Okay. Now, if you're in tier one, all you do is you fill out this first column. If you're in tier two, you got to fill out the rest of these. So you basically take your final compensation period, which is your highest 3 years of pay. Now, if you know you're making your highest rate of pay at the end of your career, and you're working full time, it's pretty easy. All you do is you take your retirement date that you're going to retire, and you just basically go back in time 3 years. And that last 3 years is going to be your final compensation period. But it's not always that way. An easy way to do it, if you don't really want to think that hard about it, is you go into your account on our website and you run a benefit estimate for your retirement scenario. And if you look at pages 3 and 4, it will tell you exactly the pay periods it's going to use that are going to be considered your final compensation period. And then what you do is you think about that 3 year period and you kind of divide it up into 3 1 year periods. And then you think about how much vacation you're earning at the end of each one of those periods and how much vacation you're allowed to sell during that period, kind of at the end of the period. And it sounds more complicated than it is. Most people, you're probably just going to have all three numbers the same all the way across. Especially the amount that you're allowed to sell. This doesn't change much unless your bargaining unit happens to, bargain a different amount. But mostly this is all three of these are going to be the same numbers. This may change. Like if you get over the 21-year mark, for example, in seniority, and you go from earning 4 years to 5 years, that may change. But in most cases, the amount you sell is going to be less. So that's going to actually, you'll see in a minute, that's going to govern this. So, it's not going to matter that much. Okay, now that you have these filled in, you have to, you're going to figure out, you're going to use those numbers to figure out what your limit is. And I'll show you our calculator, but I'll describe what it does, and you don't actually have to use the calculator. Okay, the calculator is available at acera.org/vacation. So you go out here to acera.org, you type in acera.org/vacation, and it's a shortcut to this section of this page. And if you open this first accordion, there's a calculator in here. Now you choose whether you're tier one or tier two, okay? And you put in the weeks of vacation that you earn, and then you choose from the drop down the weeks of vacation that you're allowed to sell, and it will tell you your cap on how much vacation compensation we can include as salary for calculating your retirement. You'll note with tier two, it opens up and it gives you three different areas to put in the numbers, and it gives you a running total as you put them in. But what this calculator is doing is it's just taking the lesser of the two numbers from each year and it's adding them together. So the lesser of 5 and 2 is 2 in all three cases. So 2 plus 2 plus 2 is 6. So it's a basic calculator, but that's how it works. So you don't actually have to use it. You can just plug your numbers in, add together the lesser of the three numbers in either case, and that becomes your limit in weeks of vacation about how much vacation compensation is includable as salary for calculating your retirement. Okay, so now we have your limit. What do we do with that limit? Well, if you want to get compensated for that amount of vacation up to your limit, that is the maximum amount of vacation compensation that we can include to calculate your salary. So you could just go ahead and do that. And the easiest way to do it is simply by having that amount of vacation on the books when you stop working and retire. So if your maximum, and if this was your situation in this example, your maximum was 6, you would just need to have 6 weeks of vacation on the books when you stop working and retire, and you don't even have to worry about selling any vacation back to your employer. And that's by far the easiest way to do it. You can even have a little bit more than 6 just to be sure that you get exactly 6. Okay. Now, let me give you one more example because this is going to illustrate a couple of caveats in here. Let's say that you earn 4 weeks of vacation per year and you're allowed to sell 3. Okay. There's a lot of people in management that might be in this scenario. So your limit from the calculator, if you do the calculator, is just going to add up the lesser of each one of these. And this is a tier two scenario. Tier one, it's actually very easy. You basically just do this. You just have that amount on the books. You don't have to worry about anything else because it's simplified for you. For tier two, if this is the case where let's say that we're doing this example where your limit is going to be 9 because 3 plus 3 plus 3 is 9. Okay. Your employer, and this is true for everyone, your employer has an extra rule. They will only cash you out for 2 times your accrual rate of vacation maximum. So if this person earns 4 weeks of vacation per year, 2 times their annual accrual rate of vacation is 8 weeks of vacation. Now, if they have 9 weeks on the books, they don't get anything because their employer's rule is they only cash out for 2 times their accrual rate. They'll only cash you out for 8. They'll only give you 8 weeks worth of your salary in the check, and you just basically lose the extra week. Okay, so to prevent that from happening, and you'll kind of see where this is going, if you're trying to maximize the amount of vacation compensation that we include as salary for calculating your retirement up to your cap, and you can't get up to your cap through the cash out alone because you're in a similar scenario as this, where they won't cash you out for all of that vacation, then you're going to have to sell some while you're still employed. So instead of losing that extra week by having it on the books when you stop working, by having 9 weeks, you're in a good situation because you're learning about this right now and you can say, okay, I'm only going to have up to 2 times my accrual rate on the books when I stop working. And anything above that, I'm going to go ahead and sell so I don't lose it. Or you can take the vacation. So you go out on a vacation, you don't lose it. But the alternative is to sell it. And by selling it, you get, this boost. Okay. So in this scenario, this person sells 1 week of vacation, they cash out 8, and that gets them up to their limit. And that's the only way that they could get up to their limit. Okay. Now, what happens if you've already sold a bunch of vacation? Like you didn't know about all this. You didn't know that you just want to mostly have it on the books when you stop working and you've already sold a bunch of vacation. That's fine. Don't worry. All you would need to do, you kind of have two options. Your first option is to cash out the difference. Okay, so if we're sticking with this example, your limit is 9. You've already sold 5 weeks of vacation during that highest 3 years. You can just cash out the difference, cash out the rest to get you up to the 9. 5 plus 4 is 9. Or option two is you could cash out more. You could have more than 4 on the books. You just have up to 2 times your accrual rate, so you don't lose any. Have up to 8 in this example. And you're still going to get all the cash from that. You sold 5 weeks of your vacation back to your employer while you were still employed. They paid you for that. You put that money in your bank account. At the time that you stop working, you have 8 weeks left over on the books. They will cash you out for that 8 weeks. You put that in your bank account. That's all money that you get. Okay. And Acera will take the highest of that 13 weeks that you got paid that we see in your payroll records and the highest 9, and we'll use that as salary for calculating your retirement. So you'll get the boost for the 9 weeks, but you get to keep the cash for the 13. So that's how that works. Okay, I probably forgot to say some stuff about this. If you have any questions, go ahead and type those in. I see there's one question up there. Okay, so this is a follow-up to the earlier question regarding the purchasing of service credit. So it sounds like you did withdraw your contributions in 2005, and you're thinking about purchasing the service credit back by making a redeposit. Now you're asking, is the amount that I pay back to Acera the actual amount I received when I withdrew my contribution in 2005? Yes, but you have to pay the interest that that money would have earned had you left it in the fund and we had invested it. So we have if you go out to our website and you type in acera.org/interest, you can see how much interest we've earned over history. And so you can see you're going to have to pay all of the interest from all of the individual interest periods back to 2005. So it's the amount that you took out plus the interest, and the interest will have compounded. There's actually at the bottom, there's an Excel spreadsheet in case you want to calculate the compounding yourself. I think we're about to launch a spreadsheet that will do the compounding for you, but we haven't posted that yet here, but it may be in the next week or so. So if you want to wait a little bit, you can look out for that. Otherwise, what you do is you're going to want to go ahead if you want, we're going to calculate the cost no matter what. Okay. So if you go to acera.org/purchase, um, there's a DocuSign form here, and you click on the button, and then you fill out the DocuSign form, and it's a purchase request form, and you're basically telling us you'll mark in there it's a redeposit, you'll tell us the details, and then we'll calculate the cost for you. It does could take a month or two to get the calculation back. So if your retirement is coming up soon, you may want to note that in the sheet to make sure that we are able to expedite it. Usually, if your retirement is less than a month out, where you're not really able to do purchases or redeposits because it just takes so long to do the calculations. Okay, and then there's a question. So you're saying for Alameda County, you believe you only have 2 times your annual accrual rate on the books, otherwise you stop accruing. That's true. The way I understand it works, unless it changed, is that you can only have 2 times your accrual rate on the books past this date. And they send out a reminder about the date, and I think the date is the end of the calendar year. Or it might be the last day of the last pay period in the year or something. Your payroll clerk would definitely know that. So I think during the year, you can hold a higher balance than 2 times your accrual rate. It's just every year they make you either sell it or take it before that date passes or you lose it. So yes, you're correct. But there are scenarios where you could have more than two times your accrual rate during the year. Oh, you're saying that used to be true, but you think they changed it and they'll stop granting it if you hit your cap? Very interesting. I'll have to check on that. And this example may no longer apply, especially if all the employers are doing that. Thanks for letting me know about that. Any other questions about the vacation compensation, how it boosts your retirement allowance a little bit? One more thing I'll say about that is some people will ask, is it better to take the vacation at the end of my career and be on leave that time and get more service credit rather than get the salary boost? It is not better. The salary boost is a much larger impact, a much larger effect on your retirement allowance than it would be if you took that same amount of service credit. So in all cases, it you get a higher retirement allowance, uh, and it's better if you try to maximize, get the compensation up to the cap for you. Okay, well, it seems like there's no more questions. So we'll welcome back the tier 3 and 4 members. Thanks for bearing with us on that. It's a little bit of a complicated topic, but I hope I made it understandable. Okay, so, okay, let me tell you about your some limits on your monthly benefit payments that may occur. This doesn't happen to most people, but some people. The first is that your highest average monthly salary, your retirement allowance is capped at 100% of your highest average monthly salary. So what that's trying to do is prevent you from making more money in retirement than you were making as you were working. But we just learned that your highest average monthly salary could be slightly higher with the vacation compensation increase. But in general, that's what that limit does. And that's not really bad news because if you do hit that cap, that means you're making in retirement how much you made while you were working, which is great. You've replaced 100% of your working salary with your Acera retirement allowance. Limits B and C are for people who have pretty high salaries, so I'll just let you read that on your own if that applies to you. There's more info at acera.org/limits. The other one that I wanted to mention is for Tier 4 members. The law that created Tier 4 caps the annual salary dollars that Acera is allowed to include when we calculate your highest average monthly salary. And so it's a limit. It's based on the Social Security wage index limit. The number does go up every year. We always have that limit posted out on our website. For 2025, it is $155,081 for general members and 186,096 for safety members. So if you do have a higher salary than that, we can only use up to that amount of annual salary dollars to calculate your retirement allowance. So that's kind of the downside. There's a little bit of an upside, which is that the way it works is that whenever you hit that cap in the year, let's say you hit it in September, you you make more money than, whatever the salary limit is. For the rest of the year, we stop taking out retirement contributions from your check, and that leaves you more money for the rest of the year to save in your like 457B plan, for example. Okay. Finally, let me show you how to get a precision retirement benefit estimate. So I'm going to show you screenshots because it's a little bit more efficient to do it that way. All you do is you go out to acera.org and you click the login button. Okay, and I showed you how to log in there and how to enroll in MemberDirect, the MemberDirect portal, a little bit earlier. How to get that enrollment pin if you haven't enrolled in it yet. So once you get in there, once you log in with your username and password, you go to the Estimate a Benefit tool. And it's going to ask for two dates, and I'll just zoom in here a little bit so you can see it a little bit better. It's going to ask for these two dates, separation date and payments begin date. The separation date is your last day on payroll with your employer. The payments begin date is your first day of Acera retirement. If you're planning on going straight into retirement from active work, then these would be two consecutive calendar dates. But if not, if there's a gap, that's fine. You can just, whatever your situation is, you can do it here. Okay, then for the beneficiary information, it may pre-populate if you've designated your beneficiary as an active member with Acera. And so if that is correct, that info is correct, you can leave it in there or you can type in new info. If you do leave in the pre-populated beneficiary in there, make sure the date of birth is correct because some of them aren't. And if it's not, it'll throw off some of the calculations. There's some check boxes you can use to customize your estimate. I recommend leaving them unchecked because you get a nice conservative estimate and then you hit generate. And you end up with this PDF retirement benefit estimate. And I'll zoom in on it so you can see it a little bit better. The main part, the heart of your estimate is this table right here, your estimated monthly benefit. And it shows you what your member monthly benefit, what your Acera pension will be each month for the rest of your life, depending on which one of the retirement options you pick. It also shows how much your beneficiary would receive after your death, your continuance beneficiary, what they would receive per month. Okay. And I'll talk a little bit about the 5 options in a little while. For right now, you can, just go by the, if you wanted to write in your estimate in the worksheet, you could just go by this number, the unmodified option, which pays the most, and it's what most people select. But I will talk about these other options in a few minutes when I talk about the 5 retirement options. There's also a page 2 on the estimate that shows you all of the data that it used, the formula data that it used to actually calculate that estimate. Okay. And then, like I said, you can write in your precision estimate amount on your worksheet, or, really the way to do it is just save this PDF on your device. Um, and the new member direct portal actually keeps a record of all these estimates that you've made, so you can just go back and look at them once you log in. Okay. Now, your other option for getting a precision retirement benefit estimate is to have us do it. And you do that by filling out our retirement estimate request form on our forms page. The thing with these is that one of my colleagues is going to do this for you, and they're going to use the same software. They're just using the back end part of it. You're using the portal part of it, but it's both the same software, Pension Gold. And so it's going to use the same math. You're going to get the same results when you use the online benefit estimator that they're going to give you. And there's a waiting time for this because we get a bunch of these requests. There's kind of a queue. So if you do want us to do it, you submit it and you kind of go in the queue. It may take a few weeks to get it back, and we mail it to you. So it's not an instantaneous thing, the mail. Okay. That's how to get a precision retirement benefit estimate. Now, let me help you verify your retirement eligibility. We're talking about this date on the pension milestone chart here, retirement eligibility date. This is the first day that you are eligible to retire from Acera if you want to, okay? Now, there's 3 different combinations of age and years of service credit that get you to retirement eligibility if you're in tiers 1, 2, and 3. I'll show you the tier 4 slide next. The first combination is option 1. If you are at least 50 years of age and you have at least 5 years of service credit and you've been a member of Acera for at least 10 years, you're eligible to retire. Now, the membership thing, tiers 1, 2, and 3, they all closed more than 10 years ago. You already have 10 years of membership. Just don't worry about that part. So you're at least age 50, you have at least 5 years of service credit, you're eligible to retire under this first combination. And then for option 2, you can be any age. You can be younger than age 50 as long as you have at least 30 years of service credit as a general member or 20 years of service credit as a safety member. For option 3, you have you can have any amount of service credit and be at least age 70. So you can have less than the 5 years you need for this combination one, and you could have 4 years. And as long as you're age 70, you can draw a lifetime pension from a SARA just based on that 4 years of service credit. Okay. And then for tier four, so that's tiers one, two, and three. Tier four, option one is that you're at least age 52 as a general member or at least age 50 as a safety member, and you have at least 5 years of service credit. You're eligible to retire. Or you can be at least age 70 and have any amount of service credit, even if it's less than the 5 years you need under option one, and you can retire. So you don't actually need, as you know, in most cases, for tiers one, two, and three, it's age 50 for everyone. For tier four, it's age 50 for safety and 52 for general, and 5 years of service credit. It's not actually a ton of, years of age and service credit that you need to be eligible to retire. Okay, and somebody has an age factor percentage question. Let me talk about that when I talk about the cost of living adjustment. Okay, so at this point on your worksheet, at acera.org/worksheet, again, if you want to do this purely optional, you can put in your retirement eligibility date if you happen to want to write that in. Now, if you already know you're eligible to retire based on what I just told you, don't even worry about it because the retirement eligibility date is not used for anything else besides making sure that you're eligible to retire. Okay, next topic. Let's talk about choosing your retirement date because you're going to choose it. We don't choose your retirement date for you. Okay, you tell us when you want to retire. And we're talking about this date on the pension milestone chart. Your first day of retirement, this is the date you start collecting your lifetime pension that you've been earning throughout your career. So these are the 6 things that you're going to want to think about when choosing your date to retire. So we'll go through each one of these. Okay, let me start off with the first one. Will you have enough income? This this one, it's a little bit obvious. You're probably already thinking about this when you're doing your retirement planning. But it's just something I like to mention, just in case you haven't thought about it. It's definitely good to think about in advance. If you retire, are you going to have enough money to maintain your standard of living in retirement? Or maybe you need to work a little bit longer and earn a little bit more retirement. And you can figure that out by getting that Acera Precision Pension Estimate. Also looking at how much money you have in the deferred comp program and getting a Social Security estimate and just looking at the combined income that you'll have after retirement. And if you want to, you can compare that with your post-retirement expenses if you want to get granular. Kind of the shorthand way to do it that everyone uses. Financial planners just say that you need to replace 80% of whatever you were making before retirement with your retirement income through these 3 categories: your Acera retirement, your Social Security, and your deferred compensation. And we have an article out on the website that walks you through that whole thing. If you go to acera.org, scroll down here to this berry colored section and go to estimate your retirement income, it will walk you through getting those estimates and then thinking about whether you'll have enough income to pay for your life in retirement. Okay, so that's kind of the first thing to think about. Okay, number 2, you're going to want to think about these age factor percentage dates. Now, somebody asked the question, how is the age factor percentage calculated because they came in late, and that's no worries. The age factor percentage is based on your tier. So let me just go ahead because I know I have the tier chart again here. The age factor percentage, these tiers are set by law. I'm sorry, these age factor percentages are set by law based on your tier. So whichever tier you're in, this is your set of age factors. The age factors don't change and they increase with every quarter year that you age. So the full age factor chart would have quarter year increases in here: 50, 50 and a quarter, 50 and a half, and so on and so forth. And there's a slightly higher age factor percentage that you get for aging every 3 months based on your birth date. Okay. So to give you an example, let's say your birth date is January 15th. Okay. Well, 1 quarter after your birthday is April 15th. 2 quarters after your birthday is July 15th. 3 quarters after your birthday is October 15th. Okay. Every time you pass one of these days, you age another quarter year. You go up one notch in the age factor chart. You get a slightly higher age factor percentage, which increases your retirement allowance somewhere between 1 and 1.9% just because you have aged a quarter year, okay? So the reason I'm talking about this now in terms of the in the context of the discussion about choosing your retirement date is what I don't want you to do is retire right before one of these dates. Like let's say that your birthday is January 15th. Let's say that you're still young enough where you haven't you're younger than the maximum age factor percentage for that tier because if you retire older than the maximum age factor percentage for your tier, it doesn't matter. You just get that maximum percentage. So in that case, you wouldn't even worry about these quarter year dates because it doesn't matter because you've already reached the maximum age factor percentage. But if you're younger than where the blue box is for your tier, that means every quarter year you age, your age factor is still increasing. And so that means that if you were going to retire in this example where your birthday is January 15th, if you were going to retire on July 14th, I would tell you don't do that. Wait one day. Move your retirement date one day to July 15th. Retire on that day. That means you would get credit for having aged a quarter year and your retirement allowance would be immediately 1 to 1.9% higher. The different age factors have different amounts that they increase it. Your retirement allowance would immediately be higher at the time that we calculate it and for the rest of your life just by waiting that one day. Okay. And it's the same with all of these days. You retire on that day or after. So, what I don't want you to do is retire right before one of the quarter year age days. Now, if you're going to retire halfway between, like, you're going to retire, let's say that you're going to retire like, September 1st, which is kind of halfway between July 15th and October 15th. In this example, again, this is for a January 15th birthday. Then I would say, like, you're ready to retire. You should just, retire. I don't think that you need to wait 6 weeks, work another 6 weeks to get past the next age factor day. So that's not what I'm telling you. I just don't want you to retire right before one of these days and miss out on that next age factor percentage increase. Okay. And so yeah, I hope that explains the age factor percentages. If you do want to see the full set with all the quarter year incremental increases, you can go to acera.org/age. But it is based on your age at retirement. So like if you retire at age 60 for general tier 2, 1.92% would be the age factor percentage we would put in the formula for you. Okay, let me tell you about the cost of living adjustment at this point. And this is a good time to talk about the cost of living adjustment because there is a date annually. It's an annual increase that you get to your retirement allowance. It's a percentage increase. And the reason I like to talk about it now is because there's this date, April 1st, which is the cutoff date for the cost of living adjustment each year. So it's paid on April 1st of each year. And it's calculated based on the consumer price index increase for the San Francisco Bay Area, which is calculated by the Department of Labor. Basically, if prices go up, let's say 5% between December to December of the previous year, then we're looking at a 5% cost of living increase paid on April 1st for everyone who's in retired status as of April 1st, except there's a limit written into the law that governs Acera. If you're in tiers 1 and 3, we can only pay a maximum cost of living increase of 3%. If you're in tiers 2 and 4, we can only pay a maximum cost of living increase of 2%. So then you may be wondering, okay, well, what if prices did go up 5% December to December? Am I just left hanging? Well, what we do is we save those percentages for you in what we call, kind of loosely called a COLA bank. And we will take percentages out of your percentage points out of your COLA bank in the future. Let's say the next year prices only went up 1%. Well, we'll pay you the 1% increase, and then we'll take percentages out of your COLA bank if you have bank percentages to get you up to the maximum that we can get you. It's kind of complicated. We do it automatically. You don't have to think about it. The bottom line is that if you've already been retired for a few years, you tend to get the maximum per year, 2% or 3% increase, depending on your tier, because inflation on average in the United States historically has been a little over 3%, although in recent years it's been astronomical, it seems. Okay, now back to the reason that I'm talking about the cost of living increase now is because of that cutoff date for April 1st. Okay, so if you retire, if your first day of retirement is on April 1st, you will get the cost of living increase for that year. If your first day of retirement is on April 2nd, you miss the cost of living increase for that year, but then you'll get next year's cost of living increase and every annual increase after that. Okay, there has to be a cutoff date, and it just happens to be April 1st. And this, it also happens to make it so that March is our biggest retirement month because a bunch of people who are already thinking about retiring in the spring realize that if they retire on or before April 1st, usually sometime in March, they're going to get a larger retirement allowance immediately upon retirement and for the rest of their life than if they had retired in April, like on April 2nd or after for the rest of April, because of the cost of living increase. So, not many people retire on April 2nd or through the rest of April. Lots of people retire on April 1st and in March. But really, there's nothing magic about April 1st. If you need to retire in February, January, December, November, October, September, August, July, like whatever you want, like retire when you need to. It just so happens that if you're already going to retire in the spring, you do want to consider if it's better to retire before April 1st than slightly after. But usually within a couple of months, this that problem resolves itself and it does make it so that you will earn more retirement, like if you retire in like June than you would have if you retired in March. Okay, so then that brings us to a question that may be forming in some of your minds, possibly, um, is what if there's a dilemma between the age factor percentage increase date and the COLA date? Okay, and one example for that would be that example I already gave you. Your birthday is January 15th, and your age and tier is such that you have not yet reached the maximum age factor percentage for your tier, and you're already thinking about retiring in the spring. So, if that were the case in this example, you would be choosing between retiring on April 15th or a little bit after, or on April 1st or a little bit before. So, if you retired on April 15th, what would happen? Well, you would get the age factor percentage increase for having aged a quarter year after your January 15th birthday, but you would miss the cost of living adjustment that you would have gotten had you retired on April 1st. But if you retire on April 1st, what would happen? Well, you miss the age factor percentage increase that you're going to get in a couple of weeks by having aged a quarter year by retiring on or after April 15th, but you're going to get the cost of living adjustment by retiring on April 1st. Which do you choose? Well, you probably already know what the answer is because I gave you the percentages. If the cost of living adjustment happens to be the maximum that year, and it often is, uh, and we publicize this on our website in the first week of February every year because that's when our actuary calculates it for us. So we'll publish the cost of living increase, and if it is the maximum of the 2 or 3%, depending on your tier, you would want to go with the cost of living increase because it's going to increase your retirement allowance more than the next age factor increase, which is between 1 and 1.9%. But you do not have to take my word for it, and I recommend you don't. I recommend you do your own benefit estimates. And in this case, you would just run a benefit estimate for both scenarios. You go in our benefit estimator in your online account. You run one for April 15th or what, whatever, fit this to your scenario based on your birth date. Um, you run one for getting the next age factor increase. The calculator will automatically bake in the next age factor increase. Then you run one for retiring April 1st. The calculator will not bake in the cost of living increase. You have to do a little math. All you do is you take the dollar amount that it's giving you, your estimate, and let's say that it was going to be a 2% cost of living increase that you're looking at. You simply take your dollar amount and you multiply it by 1.02, And that gives you your new estimate with the 2% increase. And then you compare the two estimates and you pick the biggest one. We always want you to pick the biggest one because we want you to get your maximum retirement allowance. Okay, so that's kind of the age factor increases, the cost of living adjustment. One more thing I'll say about this cost age factor increases and cost of living adjustment. Like if you're retiring not in the spring, you don't even worry about the cost of living adjustment date. If you're retiring the rest of the year, just think about the age factor percentage dates. And like I said, don't retire right before one. If you've already reached the maximum age factor percentage for your tier, you're already older than the age from the blue box for each tier. Um, you don't even worry about the age factor percentages at all because you've already reached the maximum age factor percentage. Okay. The last 2 points on this choosing your retirement date discussion are related, and it's like really getting granular and choosing the right date. Okay. Now this whole discussion is centered around the fact that we're going to convert your unused sick leave to service credit if you go straight from active work to retirement, like I was telling you about earlier. Okay. Now, if your plan is to not do that, you're going to leave work and retire at a later date, then we're not going to convert the sick leave to service credit. You just lose all your sick leave. That's your employer's rule. Um, and you wouldn't even worry about this whole part of it. But if you are wanting us to do the sick leave conversion automatically for you, you would just want to make sure, and it's not that hard, you just want to make sure that your last day on payroll and your retirement date are two consecutive calendar dates. They don't have to be Friday and Saturday, but you just want to have this day, your last day of work, last day on payroll. It's okay if you're on leave. You can be on vacation leave, you can be on sick leave, you could be using up a floating holiday or comp time. All that's fine. You're still on payroll. But this is the day that you write in on your letter of resignation, whatever your last day on payroll is. And this is the day that you write in on your retirement application to Acera. And as long as they're two consecutive days, it means you're going straight from active work into retirement, and we'll do the sick leave conversion for you. You'll get a little boost to your service credit. We do even offer a template of the letter of resignation. So if you go to acera.org, and I'm gonna show you this whole section in a few minutes, but I'll give you this little preview of it. If you go to prepare to retire, I'm gonna tell you about this in a few minutes, but if you go down to the last item right here, applying to retire, this is kind of your checklist of things to do right before your retirement, and it gives you all of the links to the retirement application packet because it's all DocuSign links. But then it gives you some other bonus things that it wants you to do after you submit your retirement application. And one of those things is here's the things. One of those things is to notify your employer of your separation date. We do give you a template here for your letter of resignation, and there's a Word file here if you just want to download it and you just replace, you just fill in your own info. And that is a really good way to do your letter of resignation to make sure that your last day on payroll is the day before your retirement application date. Okay, related topic, the last slide on choosing your retirement date. Again, if you want us to do the sick leave conversion, you're also going to want to make sure that you retire on a day where you are scheduled to work on the day before, and that day before should not be a regular holiday. Okay. Now, again, it's okay to be on leave the last day, just not on holiday. So, for example, if you work Monday through Friday, your first day of retirement should not be Sunday or Monday because you don't regularly work Saturday and Sunday. Okay. So if you work Monday through Friday, any of these days, Tuesday, Wednesday, Thursday, Friday, Saturday, can be your first day of retirement, but not Sunday or Monday. If you did pick Sunday or Monday as your retirement date, then we would have to put a gap between your last day on payroll and your first day of retirement, and you would lose your sick leave. Okay. If you are in law enforcement or you are in healthcare, you may not have a regular schedule Monday through Friday. So you might not pick a retirement date yet. You might pick a retirement week. And when it gets closer to the time of your retirement, then, and you see the schedule, then you pick your retirement date, making sure that you are on schedule to work the day before that. Um, and so that at that point, you would submit your retirement application with your finalized retirement date. And the other thing I want to say about this is again with number six, the day before this last day on payroll should not be a holiday. Okay, so for example, you don't want to retire the Saturday after the Friday after Thanksgiving because the Friday after Thanksgiving is a regularly scheduled holiday, and I don't remember the reasoning, but that messes things up. My colleagues have explained it to me, and I forget what it is. So just pick any other day. Okay, that's how that works. So that's how you choose your retirement date. Those are the things that you're going to want to think about. If you want to go ahead and fill in your projected retirement date here on the worksheet, you can do that. And then your separation date, if you're going straight from active work into retirement, you just know that these need to be 2 consecutive days. Okay, let me tell you now, moving on to the next section, about the application process that you are going to go through to retire from Acera. Step one, we want you to go through that preparing to retire section that I was just showing you. Okay, so you have sub steps. So again, you get there by going to acera.org. You can either go under members, preparing to retire, or you can just go down to this red colored section, prepare to retire. There's a number of different ways to get there. But what this is, it's a it's in chronological order. We want you to go through each one of these posts. There's, I think, 12 of them. You've already done a lot of this stuff. We've already verified your retirement eligibility. I already explained how vacation pay affects your pension. You're already attending a pre-retirement seminar right now. Okay, so there might be a few things that you haven't done yet, but we do want you to go through that entire section and make sure that you do any of the stuff in there that you need to do. Excuse me. Step two is to set up a ready to retire counseling session 3 to 6 months before your retirement date to fully prepare. Okay. So you can either go to the shortcut, acera.org/counseling, or you'll note that is the third to last item on that preparing to retire page, and it does tell you to do that 3 to 6 months before retirement. And all you do is you click there, and then there's a form that you fill out, um, and you fill out the form. You have to enroll in our Member Direct portal before you fill out the form, because that's how we communicate with you over email. So it'll walk you through that as well if you still need to do that. You're going to be requesting this counseling session in that 3 to 6 month period before your retirement date. And then once you submit the form, one of my colleagues will contact you and set up the counseling session in the 3 month period before your retirement date. And they will give you additional instructions at that point, and they will have you fill out the retirement application if you can, and so on and so forth. So what yeah, I'll just leave it there for now. Okay, then your next step is to submit your retirement application, and you do that within that 90 days, that 3 months before your retirement. And so the retirement application is at acera.org/retire. Okay, and I'll just go back to the website and show you that. Um, it is the last item on the list on that preparing to retire section. So this is the one that I just showed you, but there's some last steps to go through. It explains the retirement options, and then it brings you to your electronic retirement packet, gives you some instructions, and it's all DocuSign forms that you fill out electronically. There's PDF options for some of them, but I would recommend just doing the DocuSign because it's way easier. On your retirement application, you're going to do a few things. You're going to specify your retirement date. You're going to select one of 5 retirement options. You're going to nominate a beneficiary or beneficiaries for death benefits, and you're going to consider joining a retiree association. I'll talk about that more in just a second. And then you submit your application. We process it into our system, and then we have you in our system as retiring on that specific date. And then you don't need to do anything else. Once your retirement date passes, you are retired. It is going to be freaking amazing. You've been working a long career here, providing service to the residents of Alameda County, and you have earned it. So thank you very much for the service that you've been doing for the residents here. We really appreciate it, and we hope you enjoy your retirement, and we hope it's amazing. So that is how that works. Now, and somebody's asking, after I retire, can I move to a different state? California is too high, too expensive. Absolutely. You can move wherever you like. Um, we will pay your retirement allowance only to U.S. banks, but if you do move overseas, you can probably figure that out about how to access your U.S. bank from overseas. Yeah, and there's healthcare options all across the country, which I'll talk about in just a few minutes. Okay, so at this point on your worksheet, if you want to, you can write in your date to submit the Ready to Retire counseling form. All you do is take your projected retirement date, subtract 6 months, write that in. Then I also suggest go in your calendar or however you set yourself reminders, set yourself a reminder for the 6 months before you retire, your retirement date, to fill out the counseling form. Uh, if you are in the situation where it's already your retirement is 3 months out or 2 months out, go ahead and submit the counseling request form, and we'll try to get you counseled. And in most cases, I think we're able to do it. Oh, also the other thing that I want to say about the counseling is 99% of these days we do over video, so we do them on Zoom. Okay, so regarding the retiree associations, on your retirement application, there is a section where you can join one or both of the two retiree associations of Alameda County retirees. Both retiree associations, they advocate for retirees. They both publish newsletters and hold social events. Um, ACRE is the Alameda County Retired Employees. It's affiliated with SEIU Local 1021. The dues are a super cheap $3 per month. REAC is Retired Employees of Alameda County. It's unaffiliated. Dues are an incredibly reasonable $2 per month. We will, as a convenience to you, take the dues out of your paycheck, out of your Acera check, and send it over to the association for you. So you don't really even have to think about it. All you need to do is check the box on your retirement application for whichever one or both that you want to join. The social events, REAC holds a luncheon twice a year in the spring and fall. ACRE holds a Christmas luncheon or a holiday luncheon for all of the holidays that people celebrate in December. And yeah, they advocate for retirees. I go to all their board meetings. They come to all our board meetings. So we keep a really close relationship with the retiree associations, and they just act as advocates for you. And somebody heard that Alameda County will be discontinuing their Zoom account and switching over to Teams. Will that impact Acera? I don't think so. We have our own Zoom account. We have two Zoom accounts that we do those meetings on. And we also use Teams. I'm not sure, like, if you needed to use Teams, we probably could figure that out. Like, we use Teams internally, but yeah. But we have our own Zoom account. Okay, and somebody's asking about beneficiaries. I'll get to that in just a second. Your first retirement check, you can expect 4 to 6 weeks after your last employer's paycheck. 99.9% of the cases these days, because you have started the process so early with the counseling session and whatnot, we have time to calculate your full retirement, do the full final retirement calculation by the time it's time to issue your first check. If there's any major issues with your file, we will issue you estimated 80% payments until we resolve the issues, and then we'll issue you retro payments for any less than 100% payments that we needed to make. Okay, let me tell you about the retirement allowance options. And this will answer your question that's up on the board about having more than one beneficiary and updating their information. Okay, so on your retirement application, you're going to choose one of these five retirement allowance options. The options, they all differ between how much they pay you, the retiree, while you're living, and how much they pay your beneficiary after your death. Okay, that's kind of the difference between the options. And you can see that there's five of them, unmodified option and options 1 through 4. Your only opportunity to choose your option is on that retirement application at the time of retirement. You can't change your mind later. So it's good to understand what the options do for you when you're choosing it so that you know you're choosing the right one. I think there is one scenario where if you are submitting a disability retirement application, which is a separate process from this regular retirement, which we call service retirement, and that's in process, you can go ahead and do the service retirement. And then if you are awarded the disability retirement, I think you can change your option. You would want to check with our disability unit on that if you start the disability process. Okay. For each one of these five options, I'm going to show you a slide that has a whole bunch of text on it, but I'll walk you through all of it. Top, we have the title of the option. The top line of the table is going to talk about your retirement allowance as a Sarah retired member. And then all the stuff on the bottom is going to talk about what your beneficiary will be eligible for after your death. Now, a beneficiary, let me define that term. That's somebody who gets benefits. You're a Sarah beneficiary, somebody who gets your death benefits, your Sarah death benefits after your death. Okay. So, the first option, the unmodified option, the subtitle is 60% to beneficiary. For you, the Sarah retiree, this pays the highest retirement allowance of any of the five options. The vast majority of people choose the unmodified option because of that. Okay, so then at the time of retirement, on your retirement application, you designate a beneficiary. Okay. If your beneficiary is eligible for a continuance is a continuing monthly payment after your death, then your continuance beneficiary would receive a 60% monthly payment. So whatever your retirement allowance was at the time that you died, your beneficiary would receive 60% of that for the rest of their life in most cases. Your eligible beneficiaries for the unmodified option for a continuance are spouse, state registered domestic partner, or Alameda County domestic partner, and you have to have married them or registered them at least 1 year before your retirement for them to be counted for this 60% lifetime continuance. It would go on for the rest of their life. It's 100% continuance if you are awarded a service-connected disability retirement. Now, if you don't have a spouse or domestic partner, but you have a minor child or minor children, you can name them. But it's not a lifetime benefit, it's a temporary benefit. It stops at age 18, unless they maintain enrollment as a full-time student in an accredited school, and it can continue until age 22, at which point it will stop, unless they get married or register a state domestic partner in that time, and then it would stop on their marriage date or domestic partnership registration date. Okay, then if you are going to retire and you don't have one of these people to name as a beneficiary, spouse, domestic partner, minor child, or minor children, you can still choose the unmodified option. Many people do. And you can even name a beneficiary, but only for a one-time lump sum payment. So it's not going to be a monthly continuance. It's going to be a one-time payment paid sometime right after your death. And they would receive your beneficiary, and it could be anyone. It doesn't have to be all of these people. It can be anyone that you want to name. It's a one-time lump sum benefit of basically a refund of the money that's left over in your contribution account. The employee contributions only, not the employer contributions. So we would pay back the all of the employee contributions that you paid into Acera throughout your career, plus all the interest that we posted to your account over the years when the fund earned interest, minus all of the retirement allowance payments that we've already paid you out while you were living. And I will let you know that it only takes 3 to 5 years of retirement payments to exhaust the balance of your contribution account. Okay. So if you were to die, if you were choosing a modified option, name a lump sum beneficiary and die after that 3 to 5 years, when the employee contribution account is exhausted, there would be no employee contributions to pay to your lump sum beneficiary. There would, however, be some other lump sum dollar amounts, the $1,000 lump sum death benefit they would receive. If you enroll in our healthcare plans, you pay those premiums a month in advance, so you get a refund of those. There would be a partial month, probably, of retirement allowance that we have not yet paid you in many cases, so they would get that. So there are some smaller amounts that they would receive. Okay. There is an interesting implication of that, though, and it kind of speaks to the um, beauty of participating in a defined benefit pension plan is that when you retire from a SERA and start drawing that lifetime monthly pension, we basically give you back all the money that you paid in plus interest within that first 3 to 5 years that you're retired. Like we're basically refunding you that money. And then, but then you're going to be retired in most cases for many more years after that. And so everything after that is kind of like, it's almost like this amazing bonus you get, but it's just how the system works. We start paying it out of the employer contributions after that, and then the interest. And it's actually the interest that pays that we earn on your money. It pays for 3/4 of your lifetime pension. So it's a pretty good system. Okay, one more thing I want to say about the unmodified option, getting back from that diversion, is that there is a scenario where you retire, you name on your retirement application your continuance beneficiary who's eligible, but then and so you retire, you start collecting your pension, and then your continuance beneficiary dies before you do. Okay. Now, if that happens, you can name a new beneficiary in retirement, but not for continuances. The only time you can name a beneficiary for continuance is at the time of retirement on your retirement application. Um, and is there anything else I want to say about this option before we move on? The last thing I'll say about it is, well, two more things. That same thing goes for if you don't have a continuance beneficiary at the time of retirement and then you get married in retirement, same thing. You can name your new spouse as a beneficiary, but only for lump sum payments. And then the other thing I wanted to say is for the unmodified option, and actually you'll see options 1, 2, and 3, you can only name one beneficiary for a lifetime continuance. For the minor children, you can name multiple children, but it's not a lifetime continuance. Option 4 is where you can have more than one beneficiary for a lifetime continuance. I'll show you that in a minute. Okay, so that's the unmodified option. Option 1, lump sum to beneficiary is the subtitle. For you, the Acera retiree, this pays a little bit less than the unmodified option. It's almost the same, but it's just a little bit less than the unmodified option. And what this does is it is geared toward, I believe, people who would choose the unmodified option but don't have somebody to name as a continuance beneficiary. Um, so you can choose option 1, you get almost as much as the unmodified option, and it stretches out the time that there's a balance left in your contribution account. Instead of 3 to 5 years, it's 10 to 12 years. So if you were to die within the first 10 to 12 years, there would be a balance left over to pay to that one-time lump sum, that lump sum beneficiary. Again, the beneficiary can be anyone, and that's the main reason that people would choose option 1. This is the only option that never pays a continuance ever to anyone. It's only a lump sum to the beneficiary. Okay, moving on to the next option, option two. Okay, this does two main things. This allows you to leave a 100% monthly continuance to a beneficiary. So instead of 60, it's 100%. So you retire, you start collecting your monthly pension, you get cost of living increases, so you die, and then whatever your retirement allowance was at the time of your death, your continuance beneficiary, if you had chosen option two, will get that same amount for the rest of their life, plus cost of living increases. That's the first thing that it does, is it gives 100% monthly continuance. The second thing that it does is it allows you to name anyone as a beneficiary. It doesn't have to be spouse, domestic partner, or minor children. It can be anyone. And you'll note that if you do name a minor child for option number two, you can actually leave them a lifetime continuance, which you could not do under the unmodified option. Now, there's caveats. For you, the Acera retiree, it's going to pay less than the unmodified option. Okay, so you're giving the beneficiary more, you're going to get less while you're still living and collecting your retirement allowance. And there's a calculation to determine the reduction from how much less the unmodified option pays, and it's based on your life expectancies. Life, it's based on your beneficiary's life expectancy. So if your beneficiary is significantly younger than you, that means they're going to have a longer life expectancy. So we're going to calculate to pay them more and we're going to pay you less. And all of those calculations are baked into the original retirement allowance calculation. So the reduction is at the time of your retirement and for the rest of your life. And if your beneficiary dies before you do, we do not increase your retirement allowance because your beneficiary did not live out their actuarial life expectancy. Um, so that's just something to keep in mind. There is an additional caveat. If your beneficiary is not your spouse and they're more than 10 years younger than you, there is an additional limitation that the IRS limits us to, which is that in some cases, we cannot pay out up to 100% continuous. It might be less. It might be like 96% or 92%. Um, and you can talk to your retirement counselor about that. We do have info on that. If you look under option two, if you go to acera.org/options, I think it's acera.org/options is the shortcut. Acera.org/options. There's a link under option two that explains more about that. Okay. And then somebody's asking for option two, it can only be one beneficiary. Yes. Option four is the one where you can do more than one beneficiary. I'll show you that in a minute. Okay, so that's option two. Option three is very similar to option two. The only difference is that rather than paying 100% continuance to the beneficiary, it pays a 50% continuance. So you can still name anyone as a beneficiary. It's just that they will receive half of what your retirement allowance was at the time of your death for the rest of their life. Now, what this does for people is since the beneficiary is getting less, you're going to get more when as a retiree. Okay. And again, the reduction is based on the beneficiary's life expectancy. The other rules apply. That IRS rule that I was talking about does not apply here for this one because none of those reductions get it. IRS reductions get it down to 50%. So in all cases, if you choose option three, we can pay the 50% continuance. Okay, that's option three. Option four is very similar to options two and three. Okay, very similar concept. It allows you to name anyone's beneficiary for a lifetime continuance. What option four does is instead of limiting you to 100% under option two or 50% under option three, you get to pick whatever percent you want. Or you could specify a dollar amount. It doesn't even have to be a percentage. You could say $1,000 to, your nephew every month for the rest of their life. I think most people probably do percentages. You can name more, and the other thing that this does is you can name more than one beneficiary for lifetime continuance. So you have a lot of latitude to determine the beneficiaries that you want to name and what you want to leave them. And this is a good option. I'm glad this option exists because, sometimes people will want to leave their adult child a lifetime continuance after their death. Okay. And that is a really beautiful intention to leave to your child. That's a beautiful thing, a lifetime continuance after your death. It's an amazing gift that you want to leave them. But another amazing gift that you can give them is your financial solvency for the rest of your life so they don't have to worry about you. So, what you want to do is when you're getting your benefit estimates, make sure that whichever option you're choosing, it leaves you with enough money to maintain your standard of living and to live well for the rest of your life so those adult children don't have to worry about you, which is, like I said, also an amazing gift. And in many cases, probably the majority of cases, your adult children have many more earning years ahead of them as well. So, they can do their own thing. Um, but back to the option, what are the things that you can do with this? Okay, let's say that you have two adult children. Well, you can't leave them both a lifetime continuance under any of the other options. The unmodified option, you can't even name adult children for a continuance. Option 2 and 3, you can only name one person as a beneficiary. Option 4, you could name two adult children for a continuance. The continuances they have to add up to no more than 100%. So you could name them 50-50. Or if you get your retirement estimate and that takes too much away from you, because again, the reduction is based on your beneficiary's life expectancy, you could leave them 40-40% or 30-30% or 20-20%. Combined, if you left them both 20%, they would be getting basically a combined 40% continuance, but they're each getting half. Or you could have like, a nephew and a niece. You could leave them both a little something, 5% each, you know. Uh, so the only other thing I'll say about leaving a continuance to beneficiaries is you can only name people as continuance beneficiaries. You cannot name trusts or charities or estates uh, for a continuance because the beneficiary has to have a lifespan. Let me see. Anything else I want to talk about with these? Okay, and then somebody had asked, how can I update the beneficiary information prior to setting the retirement date? You update that. You tell us who the continuance beneficiaries are on your retirement application. You specifically designate them on the retirement application for any continuance that you want to leave for your beneficiaries. Okay, now going back to the retirement benefit estimate, when you do the estimate in your account on our website, and just to zoom in here, now when you get your estimate, these things might make a little more sense. You'll note that the unmodified option pays the largest. It's going to be the biggest number on the page. Okay. It pays more than options 1, 2, 3, or 4. You'll also note that the beneficiary estimated continuance is 60% of the unmodified option. You'll see that option 1, the dollar amount is a little bit less than the unmodified option. But like I said, it stretches out that time period that there's a lump sum payment available to 10 to 12 years. And in this example, it looks like it's about $23 less. You'll also note that option 2, the amounts between your estimated retirement allowance and your beneficiary's estimated lifetime continuance are the same because it pays 100% to your beneficiary. You'll also note the same is true with option 3. The beneficiary amount is 50% of option 3. And you'll see that option 3 pays you more than option two because it pays the beneficiary less. So it all kind of makes sense. Your benefit estimate once you understand what each one of those options do. Option four, we're trying to fix our calculator, and when I say fix, I mean we're trying to upgrade our calculator so that it can do option four scenarios. Currently, it can't, but we are working on that. That this might take another year to complete that project. In the interim, you can ask your counselor during your counseling session to run estimates for you for option four, or you can ask us ahead of time if you submit a retirement estimate request. And then somebody's asking, can you designate option four beneficiaries if you have a spouse or registered domestic partner? Okay, so you'll note under um, options, and in fact, it says it on the I think it's true on the unmodified option too for the minor children. But you'll note there's this note here: spouse, state registered domestic partner, Alameda County domestic partner supersede designated beneficiary. Well, what really happens is that on your retirement application, if you are naming somebody for a lifetime continuance other than your spouse or domestic partner, they have to sign off on it. So there's a page where they sign off on that. Um, because under California law, they supersede any other beneficiary. So if they don't sign off on it and you try to name somebody else for a lifetime continuance, the spouse or domestic partner would be eligible for that instead. Okay, moving right along. Let me help you understand some additional benefits. Let's see. It is 11:25. Okay, good. We have enough time to finish out everything that we need to talk about. Okay, let me help you understand some additional Acera benefits. The main ones that I'm going to show you are these non-guaranteed benefits, also known as non-vested benefits. Okay, now I said before, the concept of vesting, that word kind of just means guaranteed, and there's a set of guaranteed benefits that you get once you achieve the 5 years of service credit. You're able to kind of unlock those guaranteed benefits. Um, there's an additional extra bonus set of non-guaranteed benefits um, that Acera offers. And the reason that we offer it, we're able to offer these is because back in the 80s, the county, Alameda County, decided that their retirees needed additional funds to to pay for some of these different expenses in retirement, like healthcare expenses. So they started this reserve fund with Acera that Acera administers. Acera is in charge of the fund. It's called the Supplemental Retiree Benefit Reserve. Sometimes we send out surveys and info on this reserve fund, so you'll probably hear about it as a retiree. Um, but our board of retirement, Acera's board of retirement, is separate from the board of supervisors, and they administer the fund. Their goal is to ensure the fund's sustainability, so they set the rules and benefit amounts to make sure the fund stays sustainable into perpetuity. That's their goal. Okay, so they might reduce or eliminate benefits or change things about the benefits here or there to make sure that funds stay sustainable. They have an actuary measure the fund every year, measure the sustainability of the fund every year, just to get an idea of how sustainable it is in order for them to set the benefit levels each year. Okay, so their rules of who is eligible for the benefits. They set up the rules based on years of Acera service credit in order to qualify for the benefits one through four. The fifth one, supplemental COLA, there's not a minimum amount of Acera service credit to qualify. And the reason they did this is again to ensure that fund sustainability. So this is years of Acera service credit, so reciprocal service credit doesn't count here for this. It's just years of service credit with Acera. And starting at 10 years of Acera service credit, you start to have the ability to unlock these subsidies. The medical subsidy is the first one. It's called the monthly medical allowance. And you unlock the first level of it, which is half of the monthly medical allowance amount at 10 years of Acera service credit. And the dental and vision is paid at 100% of the premium. Medicare, uh, I'll show you that in a minute, what that pays. It's a Medicare subsidy to offset the cost of being enrolled in Medicare, and that starts at 10 years as well. So you do get a pretty significant bonus in terms of your income in retirement by achieving that 10-year service credit mark with Acera. You get the first level of the medical subsidy, you get the dental, vision, and Medicare subsidies, and that represents a good chunk of additional money in retirement that's paid on top of your guaranteed pension. And uh, forgot what I was going to say about the rest of it, but let me talk about each one of these in a little more detail, and I think that will help you understand how each one of these things works. So let me talk about the medical subsidy first. Okay, the medical subsidy is the name of it is the monthly medical allowance, MMA. It is, again, not a guaranteed benefit, but the board tries to continue offering it. The Board of Retirement is their goal. Oh yeah, the thing that I wanted to say is how sustainable the fund currently is. The fund is considered very sustainable currently. Um, the unsustainability mark that the board sets is if the actuary says it's going to last less than 15 years into the future. Currently, the sustainability years is 20 plus years, which is considered very sustainable. And there's over $1.1 billion in that fund. So there's a good chunk of money in there. And new money is coming into that fund all the time. Okay, so the monthly medical allowance offsets the cost of only a Acera-sponsored retiree medical plans, so no outside plans. We have group plan options, and it offsets the cost of the monthly premiums. We have individual plan options, and it offsets the cost of premiums, co-pays, and deductibles and other IRS-approved medical expenses. The amount of the monthly medical allowance is set annually by the Board of Retirement. You, the retiree, are responsible for any premium costs or other costs exceeding what the monthly medical allowance will help you pay for. And then it's not available for your beneficiaries, your survivors, former spouses, dependents, anyone else. You can enroll them in the coverage, but there's no subsidy for them. They do get to enjoy the, whatever the premium level is that we set. So they do get the benefit of that. So the monthly medical allowance amount for 2026 at the 20 or more year level, if you have 20 or more years of service credit when you retire, you're eligible for $687.21 per month to pay for your medical expenses. If you have at least 15 years, but not 20, it's $515.41. And if you have at least 10 years, but not 15, it's $343.61. Okay. So this is the monthly amount that would subsidize your medical insurance coverage. Now, I'm going to show you in a minute the premiums for next year, so you can see how much of the premium the monthly medical allowance will cover. Um, so these are uh, so what you're seeing here is a table of the different plan options. We have two different sides to the table. We have the non-Medicare eligible plans. So if you're under age 65, generally you're not eligible for Medicare unless you have a qualifying condition. So you would be choosing from these options. If you are over 65 and older, you are eligible for Medicare. So what you do is you enroll in Medicare and then you choose, if you want to, one of these additional bonus options that enhance plain Medicare. So you get a higher level of coverage than Medicare alone. Open enrollment for Acera is the month of November. For some of the individual plans, it's a little bit extended, but for the group plans, it's the entire month of November. And so now what I'll do is I'll show you the group plans for if you're not Medicare eligible. Sorry, I should have taken this one out. This one's going away. this year. So it's just there's two group plan options, and then there's individual plan options. And for the Medicare, there's a group plan option and individual plan options through Via Benefits. So I'll talk about the group plans first, then I'll talk about the individual plan options together because it's a little more efficient that way. I'm just going to basically show you the premiums. The full details of each plan are in our annual enrollment guide that we publish each year. So this is our 2026 enrollment guide. We send it to you in the mail every year in your open enrollment packet in October. And you can get the digital version if you go to acera.org/guide. There's a 36-page PDF there. Okay, so here are the non-Medicare group plan options. You have the Kaiser Permanente HMO, and you have the United Healthcare Signature Value HMO. Okay, you can see that the Kaiser HMO is cheaper. I should have deleted this too. See, I was making changes right before this, and the county, they're the ones that negotiate these plans, and the Signature Value Advantage plan, it changed, and so they decided to discontinue it, which is why it doesn't show up here, and so I should have deleted this as well. So I'll delete that after the presentation. But your two options, group plan options, are the Kaiser HMO and the United Healthcare Signature Value HMO, and you can see what the premiums are. So you can see that the monthly medical allowance amount, it, I mean, it's obviously nowhere near paying for 100% of the premium if you're not yet Medicare eligible. So if you go back to the MMA slide, even if you have 20 or more years of service credit at 287.21, um, 287.21. I'm sorry, 687.21. And $1,133.80. So it's only paying for about 60.6, 61% of your premium if you enroll in the cheapest option, the Kaiser Permanente HMO. Now, if you live in this, these are for people who live in the California service areas only. So it's San Francisco Bay Area, Sacramento, Fresno, Southern California, and Santa Cruz for the Kaiser plan. If you live in the service area, you have to, and you want medical coverage through Acera, you have to choose one of these plans if you're not Medicare eligible yet. I think we're going to talk about changing that for the 2027 plan year. I think there are going to be some discussions, but we haven't gotten that far yet. We're going to talk about that next year. For right now, that's how it works for 2026. If you live in the service area, you have to choose one of these plans if you want our healthcare coverage. If you live outside those service areas, then you would be choosing an individual plan through Via Benefits, which I'll talk about in a few minutes. Okay, and somebody was asking how the payments above the monthly medical allowance are taken out of your retirement pay. Here's how that works. What this is kind of a very simplistic version of your Acera check stub for your Acera monthly pension payment. So you have your gross pay, okay? Let's say it's $4,000. Then you have a deductions column, and yeah, so you have your deductions, and you have the Kaiser HMO amount coming out of your check. So we'll deduct that from your check so that it's convenient for you, and we'll send it over to Kaiser Permanente. So you don't have to worry about paying your monthly premium. And then whatever monthly medical allowance you're eligible for, we will put back into your check in the additions column. And you end up paying the difference out of your check in that way because you end up paying the difference between what the premium is and what the monthly medical allowance covers. There, you'll see in your actual check, you'll see more deductions if you enroll in vision, dental. You'll see if you enroll in the ACRE and REAC retiree associations, you'll see those deductions come out. You'll see taxes come out, so tax withholding. You're not going to have to pay into Social Security or Medicare anymore, but you will owe income taxes because you did not pay income taxes on your contributions to Acera, so you're going to have to pay income taxes on disbursements coming out of your Acera pay pension payment. And then one more thing I want to say about this is all of these subsidies, none of them are taxable income. So this right here, 687.21, is not taxable income. You do not have to pay income taxes on that. We have a letter from the IRS specifying that. So none of them are taxable income. And then there's a question that just popped up. Is Acera considering challenges that might occur with the Medicare-based um, that might occur with Medicare? I see. Is Acera considering challenges that might occur with Medicare based on actions taken in Congress? It is something that we monitor. We have a benefits consultant, Siegel Company, that they have a whole legal team that monitor everything that's going on in Congress regarding medical and healthcare benefits and Medicare specifically. So it is something that we keep track of on a regular basis. Um, and we're constantly looking at that, and they're constantly reporting to our board of retirement on any changes that are taking place in Congress. So yes. Okay. So that's the two early retiree is what we call it in our pension lingo. If you're not Medicare eligible, we call you an early retiree if you retire under age 65. So those are the two early retiree plans, group plan options. Then we have the Medicare group plan option, which is the Kaiser Permanente Senior Advantage plan. So for all of the Medicare options, what you're doing is you're enrolling in Medicare, which is the federal government's subsidized healthcare system. And then if you want to, you can enroll in an additional amount of coverage, which are the Medicare group plan or one of the VIA benefits individual Medicare plans. And it gives you a higher level of coverage than just plain old Medicare alone. It's optional. You can just enroll in plain old Medicare if you want. But if you are eligible for the monthly medical allowance, it does benefit you to enroll in additional coverage through Acera. And you'll see that in just a second. These are for the Kaiser Permanente Senior Advantage Plan. The service areas are again San Francisco Bay Area, Sacramento, Fresno, Southern California, Santa Cruz. San Diego is part of Southern California, to answer your question. Um, and then, so what you'll see here is the premium, the self premium for being enrolled in the Kaiser Permanente Senior Advantage Plan. You can see it's much cheaper than the early retiree plan because Medicare is paying for most of the cost of coverage. It's $398.05. And there are different premiums based on different combinations of having your family members enrolled. Okay, so you can check those out. One thing that I've done on this slide is I put in the 20-year monthly medical allowance amount um, here so that I can subtract out the monthly medical allowance from the premium, and you can see what your out-of-pocket cost is on the bottom line. One of the reasons I did that is to illustrate this point that one of the board's rules for the monthly medical allowance is it only pays for the group plans up to the amount of the self premium. So on the group plans, you do not get to keep the change, which is why the premium amount and the monthly medical allowance amount are the same for this group plan because your monthly medical allowance amount becomes the amount of the self premium. So, you know, that's that's how it works. The good news about that is that what it costs you out of pocket, zero. If you have 20-year monthly medical allowance or even the 15-year monthly medical allowance, if you enroll in the Kaiser Permanente Senior Advantage Plan, you pay nothing because the monthly medical allowance pays the whole monthly premium for you. And then you would just have to pay the copays. Okay, so those are the group plan options, group medical plan options. Okay, now we have individual plan options through this company that we contract with called Via Benefits. Okay. Now, to start off this discussion, what I want to talk about is who can enroll in a Via Benefits individual plan. Okay, if you're not yet Medicare eligible, you're under age 65, you have to live inside the US, but live inside the US, but outside of the group plan service areas. So if you live in Oakland, that's in both the Kaiser and UHC service area, so you can't enroll in an individual plan. But if you move up to Redding, that's outside the service area, or you move over to Nevada, that's outside the service area for the group plan. So then you're looking at enrolling in an individual via benefits plan. If you're Medicare eligible, by being age 65 or older, you just simply have to live in the US anywhere and you can find a plan. There's many plans in many of the places. All you need to do is maintain enrollment in Medicare to be able to enroll in the additional bonus Medicare coverage. Excuse me. So you can live in San Leandro and enroll in a Medicare plan. You don't have to choose the Kaiser Permanente Senior Advantage plan. You can choose an individual Medicare plan through Via Benefits. What is Via Benefits? It is basically a massive, ginormous insurance broker. They contract with 100 plus different insurance carriers. They offer thousands of different plans through those insurance carriers. And basically, what we contract with them to do is two things: to match you with the plan that's right for you, and to administer the payments and reimbursements. Okay, so you're choosing an individual plan. You're not in a group plan if you're getting coverage through them, and the service area is nationwide. Different plans are offered in different places. Enrollment, you can do it online or over the telephone. If you don't do it over the telephone, you talk to a benefit advisor who is non-biased. They are paid a salary and there's a certification that they get for the different states that they work with. And so they are only narrowing down the plans to what's right for you based on what you need. They're not pushing you into a particular carrier because they get more from a particular carrier. So they're non-commissioned. The premiums depend on which plan you select. So you can, it depends on how much money you want to spend, how high of a coverage you want. So you narrow that down with them. When you call them, basically you tell them how much money you want to spend, how much coverage you want to have, where you're going to live, if you're going to move out of state, or where you currently live. You can even get as granular as which doctors you want to visit and what prescription drugs you need. And they will narrow down all the plans to make sure that you are getting the lowest cost plan for the highest amount of coverage. Um, Also, with the individual plans, the monthly medical allowance not only pays the monthly premium, it also pays for any deductibles if you select a deductible plan, and will also pay for copays and other IRS approved medical expenses. And somebody's asking, will the counselors cover this option during the pre-retirement appointment? Yeah, they can answer any questions about any of this, and they will help during the counseling session, the Ready to Retire counseling session. They can help you fill out the healthcare forms as well, and in if you're enrolling in a group plan, or they'll cover the via benefit options. What they won't do, what they cannot do, is talk to you about individual via benefits plans because they're not experts in that. Via benefits um, benefit advisors are the ones that are experts in that. So what they would do is they would guide you to talk to the Via Benefits benefit advisor to pick your plan. Okay, now regarding the monthly medical allowance, it works a little bit differently than if you were to choose a group plan. Okay, so if you enroll in a Via Benefits individual plan and you're eligible for the monthly medical allowance, we don't put it into your Acera retirement check. Well, this is one of the things that we contract with Via Benefits to administer. What we do is we send your monthly medical allowance dollars over to Via Benefits and they put it in a health reimbursement account for you, which is what HRA stands for, and then it will sit there. Okay. Then you enroll in an individual Via Benefits plan with they enroll you directly with an insurance company. Via Benefits is just the facilitator for that. So you're going to pay the insurance company directly out of your bank account, but they help you set up automatic recurring payments to your insurance company. Okay, then you get enrolled in your insurance, and then you are going to visit the doctor probably to use your medical benefit. Then you're going to pay a copay to the doctor. So now you're out some more money. What you do now is you submit reimbursement claims back to Via Benefits, and they will pay you they will reimburse you for the money that you're out from your health reimbursement account for the MMA dollars that Acera put over there for you to reimburse you for that. And they will help you set up all this stuff to happen electronically and automatically. And you can submit reimbursement claims. They have an app that works really well. You can also submit them through their website. So they make it as easy as possible for you to do that. Okay, and then one more thing I want to say about the monthly medical allowance. This is something that the board decided as one of their sustainability measures for the monthly medical allowance. When they studied the costs, the premium amounts of the individual Medicare via benefits plans, they found that the plans tend to be very inexpensive in terms of the monthly premiums and the different expenses around the those plans. So what they decided to do was offer a slightly lower set of monthly medical allowance amounts for the Medicare people enrolled in the via benefits plan. So those are listed out here. They do keep track of whether these dollars are sufficient to pay for people's medical expenses. We get a report every year on this. They see what percentage of people ran out of money, and they do make adjustments to make sure that it's the MMA is serving the majority of people while staying sustainable. Okay, so those are the medical benefits. If you're not eligible for the monthly medical allowance, just real quick, you can still enroll in our medical coverage. You just have to pay, the full amount of the premium. And the only stipulation there is your Acera check has to be at least as much as the medical premium for the plan that you want to enroll in. Okay, so let me move on to the dental coverage. We have two different dental plans, both offered through the same insurance carrier, Delta Dental. There's a Delta Dental PPO, which is a nationwide plan, um, and there's a Delta Care USA, uh, which is a California only plan, and it has a specific service area to it. There's some differences between both. You can find the differences between those two plans in our enrollment guide at acera.org/guide. Um, the Delta Dental PPO, it has a $1,900 subsidy limit, so you have 1,900 subsidy dollars to spend each year on dental care, and your regular cleanings and diagnostics don't count against that 1,900. Okay, so the way this works is you have two different groups of people. You have people who retired from Acera and had at least 10 years of Acera service credit at retirement or a service-connected disability retirement. And if you fall into that group, enrollment in one of these, at least one of these dental plans is mandatory. Like you have to pick one, but it doesn't cost you anything to just enroll yourself. The self premium and the subsidy amount are the same. Okay. So, for example, if you had at least 10 years of Acera service credit and you picked the Delta Dental PPO and you just enrolled yourself, you would see 5435 come out of your check, and we'd send that to Delta Dental for you. You'd see 5435 go back into your check, and it would end up costing you zero. You can enroll Self Plus One, and you just pay the difference. The subsidy amount stays at 5435, so you pay the difference between 105.54 and 5435. So that's how that works with the mandatory enrollment. If you have less than 10 years of Acera service credit, you can still enroll. There's a different set of premiums and there's no subsidy. And if you're hearing chickens, my neighbor's chickens come over to my yard every afternoon and cluck outside the back door because my wife feeds them snacks. Okay, so then we have a vision plan, and it's very similar. So you have the mandatory enrollment. If you have at least 10 years of a service credit or service-connected disability, you have to choose at least the VSP standard plan. But it again costs you nothing. The self premium and the subsidy are the same amount, $4.63 is this premium and the subsidy. So if you enrolled in this, you'd see 463 come out of your check, 463 go back into your check. And again, you can enroll family member self plus one, and you can also enroll in a higher level of coverage called the VSP Premium. And there's a few differences between the standard and the premium. One I know off the top of my head is with the standard, you get frames every 24 months. With the premium, you get frames every 12 months. And then again, with the voluntary enrollment, if you have less than 10 years of Acera service credit, you can voluntarily enroll. There's a different set of premiums and no subsidy. Okay. The fourth non-guaranteed benefit is the Medicare Part B reimbursement plan. Now, the reason we offer this is because whenever you turn 65, we stop allowing you to participate in the before 65 medical plans and we make you choose one of our Medicare options. Okay. And then to choose one of our Medicare options, you have to enroll in Medicare. When you enroll in Medicare, there's four different parts to Medicare. Medicare Part A is hospitalization coverage. Medicare Part B is doctor's visits. Medicare Part C is like this um, part of the law that allows for these bonus plans to be offered, these extra coverage plans. And Medicare Part D is prescription drug coverage. Okay. Now, Medicare Part A, if you have paid into the Medicare system for at least 10 years while you're employed, you don't pay anything for Medicare Part A, the hospitalization coverage. Everyone pays everyone pays a cost for being enrolled in Medicare Part B. And the lowest cost that anyone pays in 2025 is $185 per month. Most people pay $185 per month. If you have higher incomes, there's higher levels that you pay, but the income brackets are pretty high before you start having to pay more. Um, so what the board has decided is because we make you choose the Medicare coverage, we'll go ahead and subsidize the cost of being enrolled in Medicare Part B for you as long as you have at least 10 years of Acera service credit when you retire or service-connected disability retirement. All you need to do is enroll in Medicare Part B and maintain enrollment in Medicare Part B. And once you're Medicare eligible and you get your Medicare card, you submit this Medicare Part B reimbursement form to Acera one time and you just maintain your Acera Medicare Part B enrollment. I'm sorry, your Medicare Part B enrollment with Medicare, and we will pay you. We will start paying you this Medicare Part B reimbursement in your pension check. You'll start seeing $185 show up in your pension check. That helps you pay for the cost of being enrolled in Medicare because Medicare will start charging you if you're already collecting Social Security. They'll take it out of your Social Security check. If you're not, they'll start charging you on a quarterly basis, but it'll cost this much per month. Um, so this is an amazing benefit that we offer, and you just got to remember to enroll. Whenever you become Medicare eligible, I suggest go out to our website, go to acera.org/Medicare, and this takes you to our Medicare page. And there is a step-by-step um, sequence of information that you need to learn. So we got step one, step two, and there's little accordions here that pop open and give you more information. And it guides you through the entire Medicare enrollment process and tells you how your Medicare plans work with the Acera plans. Okay, and then finally, the last non-guaranteed benefit that Acera offers is the supplemental cost of living adjustment. This is a really powerful benefit. This helps you maintain at least 85% of your original buying power that you enjoyed at the time of retirement at any point in retirement. So what that means is if you lose more than 15 percentage points of your buying power to inflation, the supplemental cost of living adjustment kicks in and keeps you at 85% of your original buying power. The way it looks to you is that when you first retire, you'll start getting the guaranteed, the vested cost of living adjustment. Okay. And you'll start seeing that happen. And then at some point in your retirement, your buying power will have eroded enough because inflation is a little bit higher than that guaranteed COLA, where the supplemental cost of living adjustment kicks in. So you'll see that show up in your retirement check, and it will keep you at 85% of your original buying power for the rest of your retirement. So it's actually amazing. And when we survey our members, sometimes occasionally about, and we ask them to rate the different non-guaranteed benefits, just so the board has an idea of which ones are more important to members. This one always comes in at number two because it's really important. Okay. So this is kind of our last topic here. So we do have a little extra time. So let me go through this last slide here. Um, oh, actually, no, this is our second to last topic. I have two more slides. Okay, so what happens if you want to work after retirement? Because some people want to do that, or sometimes you have to work a little bit after retirement to get a little extra money to maintain your standard of living. So what are the caveats around that regarding Acera? Okay, so you kind of have two options. If you want to work somewhere else, and when I say somewhere else, I mean not for one of our six participating employers, we don't care. You just go work wherever you need to work, wherever you want to work, and you're going to continue getting your retirement payments every month for the rest of your life with no stipulations. So you can go work wherever else you want and still be an Acera retiree. Okay, option number two is that you can come back to work for one of Acera's six participating employers. Some people will do this because you have a relationship with your employer and you'll want to go back to work for your employer. They'll offer you a job after your retirement. So, what are your options regarding that? Well, you kind of have two sub options. And this is brand new. This just happened within the last year that you have the ability to come back to work. And you'll see option B is brand new. So, you used to have only option A, which is that you come back to work for your Acera employer and you continue your Acera retirement payments. That is called, the people call this being a retired annuitant. You're working as a retired annuitant. So you're getting paid by your employer, and you're also getting your Acera pension payments. So if you do that, you do not earn any additional retirement credit. There are restrictions on it, and you can check out what the restrictions are at acera.org/working. There are different restrictions. There's duration limits. You can basically only work half time. There's a waiting period. You have to wait like 6 months before you can be hired back. So there's different stipulations on that. Okay, option B, if you do want to come back to work for your Acera employer, is that you can pause your retirement payments. This is the brand new option. You can pause your retirement payments. And what will happen is you go back to work for your Acera employer and you earn more credit toward retirement. You basically earn a second retirement. And at the second retirement, so let's say that you go back and you work for another couple of years. Well, you don't have to abide by any of those retirement eligibility requirements anymore. You just go back to work for however long you want and then retire for your second retirement whenever you're ready. And you just fill out the retirement application again. At your second retirement, what we do is we'll restart your original pension payments and we'll add to that your new pension payment that you got from earning additional credit toward retirement when you were earning your second retirement. Additionally, you're not going to miss out on any cost of living adjustments that you would have gotten had you been taking your pension during that time that you were working, because we'll calculate all that in. And so what this is a brand new way to go back to work for your Acera participating employer after retirement and earn additional credit toward retirement. Now, it's brand new. It's something that the county adopted sometime within the last year. More info on that at acera.org/working. Okay, so this is really the last topic that we have. There's just a few life events that I want you to know about. I don't really have full-blown slides on these because they don't necessarily apply to everyone, but I just want you to know that this information is out there on our website and that these concepts are in existence. So there's this first concept, deferring retirement. So I kind of mentioned this a little bit during the presentation. If you stop working for your employer and you don't retire immediately, you defer your retirement to a later date. In that interim period, we call you a deferred member. You're still an Acera member. You still have your contributions on deposit with us. It's just that your retirement date is going to be some other time in the future, and you can retire out of deferred status, no problem. Okay. There are some things that you're going to want to know about being a deferred member, and you can read all about those at acera.org/deferred if that's your plan. Okay, second topic. Um, Death benefits should you die before retirement. So we are our members dying before retirement is pretty rare, but we do offer the beneficiaries death benefits to members who die before retirement. Okay, so there's more info on that whole concept at acera.org/death. It tells you what all the benefits are that your beneficiaries would be paid should you die before retirement. Um, on that page, you can learn about the advanced death benefit election, which is also a brand new option for you all. I think we instituted that about a year and a half ago. And what that does is it allows you to pre-designate, pre-maximize the benefits that would go to your beneficiaries should you die before retirement simply by checking one box on the beneficiary designation form. We sent out a communication about that whenever we instituted it about a year and a half ago. If you never took action on that, go ahead and do that today. The shortcut to get to the beneficiary designation form is acera.org/BEN. That will pop open the PDF immediately. Um, and then all you got to do is download the PDF to your device. It's electronically fillable. You check the box for the advanced death benefit election. There's no downside, and it explains that on the form. There's no downside. Everybody should do that to make sure their beneficiaries would be provided the maximum benefits should they die before retirement. And then there are 5 different options on the last page for you to submit that beneficiary designation form. Okay, divorce or domestic partnership dissolution. We have a whole page on divorce and domestic partnership dissolution at acera.org/divorce. California is a community property state. Your Acera retirement that you've been earning while you're married or in a state registered domestic partnership is considered community property. It is part of the property that gets divided or sometimes gets divided whenever you do your divorce settlement. Sometimes people are able to negotiate different assets to their ex-spouse and keep their Acera retirement, but often what happens is your account will get split and your ex-spouse will get part of your Acera account. And so there's more information on that at acera.org/divorce. Okay, disability retirement. I really didn't touch on this at all, but it's a whole separate retirement track. And it's separate from the service retirement where, the service retirement is that you go through your career, you plan to retire, and then you retire. But if during your career you become permanently disabled and you can no longer perform your job duties, we have this separate thing that you can do, which is apply for a disability retirement. And there are 2 types. There's non-service connected and service connected, depending on whether your disability arose out of your employment or not. There's a ton of information on our website about it. And there is a walkthrough form that will ask you questions to determine whether you should apply for disability retirement or not. And finally, if you relocate after retirement, please complete our address, um, our address change form to give us your new address. It is a DocuSign form. It's very easy to do. Just go to acera.org/address. If you have any questions as you're preparing for your retirement, definitely contact us. You can email us. If you go to acera.org/contact, there's instructions on how to log into MemberDirect and email us in the message center there. You can always call us at 510-628-3000 during business hours. And like I said, my colleagues are just waiting to answer your questions. So on behalf of Acera's Board of Retirement and Acera staff, we wish you a beautiful retirement. You earned it. Thank you for your service to the residents of Alameda County. Okay, so at this point, that concludes the Acera portion of the presentation, and we ended a few minutes early, so that's good. We were a little efficient. So I'll go ahead and introduce Gene Hilliard. Gene Hilliard is he has been contracted for many years with Alameda County to provide financial education regarding the deferred compensation program and the 457B accounts that you all have access to as government employees. It's kind of like a 401k, but for government workers. So if you already have a 457B account, definitely stick around to listen to what Gene has to say about what you need to know about that leading up to retirement and post-retirement. If you don't have an account, I think he might tell you a few things that might inspire you to start an account, even if you just have a few years before retirement. And if you don't work for Alameda County, 99% of what he's going to tell you still applies to you if you work for one of the other five employers. So definitely stick around and hear what he has to say. Okay, good to see you, Gene. Thanks for being here.
Perfect. Hey, I put on a tie this morning because I had a couple of meetings, so I figured I'll turn on my camera. Why not? um,
All right, yeah, go ahead and share your presentation whenever you're ready.
all right, let me see if I can figure out how to get this to work. Slideshow. Bingo. How are we looking, Mike?
I'm just seeing okay, there we go.
There we go.
Perfect.
All right, perfect, perfect.
Take it
Well,
away.
good afternoon, my Alameda County family. Again, like Mike said, my name is Gene Hilliard. I'm Vice President, Financial Advisor of Emerge Financial Group. We're a financial services company in Oakland. I help my clients with creating wealth, passing on that wealth to their family, grandchildren, children, etc. And I'm a retirement counselor. Been doing this for 20 plus years. I've been working specifically with Alameda County employees through my relationship with the county and Empower for the past 16 years. Uh, and really, what I've focused on is retirement planning. You know exactly what is retirement planning. It's helping each and every one of you maintain your current lifestyle in retirement, right? You're halfway there for many of you because you work for Alameda County, you have a Sarah. At a minimum, you're looking at 50% of your salary. Now it's my job, your job to help you cover that next 50% or 30% because most financial planners say you only need 80, but it's up to you. I'm not going to spend a whole lot of time on deferred comp per se. I want to talk a little bit more about what you should expect in retirement. So we want to gear up for a greater future. So let's go ahead and get started here. These are pretty much the touch points throughout this presentation, the quote unquote retirement mile markers. It starts with conducting a situation analysis, determining your retirement income, where it's coming from, Social Security. We'll spend a little time on health insurance, estate planning, your drawdown strategy, meaning how much should you withdraw from your deferred comp to avoid running out of money, being responsible with it. And we'll talk about required minimum distributions briefly. Okay, so let's start with a situation analysis. You know, we want to find out if there is a problem sooner rather than later as it relates to retirement. Now, in my experience, many people wait until like 55, really almost 60, before they're determining whether or not they're in a good space for retirement. And I think you should be doing that sooner than that, in your 50s, or late 40s. You want to conduct a situation analysis. So, what sort of information do you need for that? Well, you want to have an idea of what your retirement savings is to date. How much do you have in your 403B, your 401k, your 457, other retirement plans? You want to have a bit of an idea of how much you should expect to get from Social Security. Go to ssa.gov to figure that out. And write down the number for how much you will receive at 62, how much you will receive at 66 or 67, and also at 70. Available assets. How much of your assets that maybe are at the bank are earmarked for retirement? Your current expenses, right? What are your bills today? What are your projected expenses in the future? Okay. So those are some of the things that you want to have gathered in order to conduct a situation analysis. If you need some assistance with this, just have that information handy, schedule an appointment, and we'll help you crunch the numbers. Here are the suggested milestones. Some of the things you want at what age you should start thinking about certain things. So, age 50, you want to conduct a contribution checkup. How much are you contributing to deferred comp or retirement? 59 is an age you want to stop and ask yourself, all right, what are the pros and cons of early withdrawals? Now, the good news, if you invest in deferred comp, there is no such thing as an early withdrawal penalty, so that doesn't apply. But if you have a 401k from your previous employer, 403b, and you're 59 and a half, you actually technically can gain access to your money without a penalty. But don't just withdraw just because you can, but you kind of want to know the pros and cons with in relationships to withdrawing at 59 and a half. 62 is an age you want to stop and think, all right, is it appropriate for me to start collecting Social Security? Yes or no? 65 is an age where you want to consider signing up for Medicare. So you want to stop, call Acera, have a conversation about Medicare. If you were born before 1960, technically you can start collecting Social Security with full benefits. If you were born after 1960, the full Social Security number benefits is 67. So when you're 66, 67, you want to think about whether or not it's appropriate to start collecting now or possibly wait until you're 70, which brings me to that next bullet point. Okay. And then lastly, 73 is the required minimum distribution age. That has changed. I'm sure many of you are thinking, well, I thought it was 70 and a half. Well, now it is 73. But keep in mind, real briefly, if you are 73 and you are still working for the county, you're not required to take out this minimum required distribution. So if you have any questions in relationship to that, if you're 73 and you're planning on continuing to work for a little while, I can help you there. Okay. All right. So let's talk about let's focus in on if you are under 50 years of age. Keep making your contributions, right? Max is 23.5. I'm going to get to that. But you want to continue to increase how much you're contributing to deferred comp, preferably 1% a year, or if you can do more than that, that's great. When you're under 50, I think you should try to focus on getting raises, getting promoted, increasing your income. That will help you twofold. Number one, if you're making more money with the county, that means you can put more money into deferred comp. So that's going to help you. And then number two, that's going to increase your average salary. Remember with Acera, and Mike, if you're still listening, correct me if I'm wrong, but Acera looks at your highest 3 years of salary to determine how much you're going to get from your pension. So
In most cases.
What's that?
In most cases, if you're tier 2 and 4.
Okay, in most cases. Thank you. Got it. So it can help you by focusing on continuing to try to, advance your career, make more money. Okay. Review your asset allocation. Do you have too much in something safe or too little in stocks, etc.? So review your asset allocation. Make sure your money's in the right place. Review your retirement strategy. Okay. Do you anticipate retiring at 62 or is it 65? Okay, kind of review that information and then start thinking about estate planning, especially once you've decided to start a family. Okay, just briefly think about, okay, if I'm no longer with us, my family, will they be taken care of? Will my spouse, will my kids be provided for? So those are some things you want to be thinking about. when you're under 50. Okay. Now let's talk about if you're 50 plus. I'm going to briefly go through maxing out and catching up is what you should be thinking about age 50, fine tuning your estate planning and making sure your beneficiaries are in place. Okay. So the IRS limit right now in 2025 is 23,500 if you're under 50 years of age, an extra 7,500 if you're 50 and over. Um, Limits in 2025 for IRAs are the same, 7,000 and 1,000. Unfortunately, we haven't been officially notified of what the new maximums are for 2026. So I'm not going to speculate there, but I will say that typically, these numbers go up by like $500, $1,000 max. But stay tuned. We'll reach out to each and every one of you to let you know exactly what the maximums are for 2026. Okay. If you are 54 and a half at the earliest, you feel like you haven't taken full advantage of deferred comp and you want to kind of make up for lost time, there's something that's called the 3-year catch up. This is a program where you can invest $47,000 a year for the next 3 years prior to retirement. And you don't have to retire after the 3 years, but you just have that 3-year window, and it's a consecutive window. You can't start and stop. You have to, if you decide you want to take advantage of this, you have to see it all the way through, and money comes from your paycheck. So some of you may have to invest half your paycheck to take advantage of that. I don't know. But if you're interested in learning more about the 3-year catch up or the last 3 years special catch up, let me know. Okay, let's talk about estate planning a little bit. Many people think that estate planning is only for people who are rich. Well, I say if you own a home in the San Francisco Bay Area and you've held it, you've had it for 20 plus years, you're considered rich, right? And so you want to start thinking about estate planning. What's part of estate planning? Well, you have your taxes, you have wills. Does a trust make sense? You want to iron out who's going to get this special family heirloom, because this is something I'm telling you, your kids, your family members may fight over. So you want to have that included into your estate plan. You want to make life easier for your family because it's going to be hard enough dealing with your loss, but you want to make the money situation as seamless as possible. So try to think long and hard about creating an estate plan. Okay. What is a living trust? A living trust typically is used to help skip probate. What is probate? Probate is the process where your family members have to solicit the court system in order to determine how your assets should be split. A will is not enough. A will still has to go through probate. Okay, so it's extremely problematic. It takes a year before truly all of your beneficiaries get their money versus if you have your money inside of a trust, everything could be split pretty quickly. Creating trust aren't really that expensive any longer. If you have signed up for, I believe it's called MetLife Legal through the county, you can hire an estate planning attorney that can help with that. Number two, I believe EAP can help with finding an attorney for you. If you need some assistance from me, Gene, do you know an estate planning attorney that is appropriate for me in my situation? I can help you out with that. So just reach out to me. So living trust, naming a beneficiary on your retirement accounts, keep in mind that does not go through probate. So you don't have to worry about that, but you want to make sure that your beneficiaries are accurate on all of your accounts. Okay, so I would encourage, if you have deferred comp account and you're unsure who your beneficiaries are, create a user ID and password for the Empower account and then just add your beneficiaries right there on the site. That's going to be your new beneficiaries. Okay. And this is, if you log on to AlamedaCountyDCP.com, if you have a user ID and password, not put that in there. If you need to register, do what you have to do, and then add your beneficiaries. Okay. Let's talk about a little bit about tax diversification. All right. Here's an example of a person who's retired. They've decided to take $50,000 out of their deferred comp account. They've invested the money pre-tax. Okay. So you're looking at roughly 20% tax bracket. Um, you're looking at netting $44,000. Okay. So that's a pretty significant tax hit. But let's say hypothetically you decided that you wanted to put a portion of your money in the pre-tax version of the of deferred comp, and you wanted to put a portion in the Roth version of deferred comp. You're retired. That's basically going to cut your taxes in half when you start to withdraw money. So you're only going to be taxed on the 25,000. That's the taxable income. The Roth side, there's no taxes at all. You already paid the taxes going in. So this is something that I'd like everyone to consider, is to, kind of have a little bit of your money invested in the Roth after tax and pre-tax. Okay. If you have more questions regarding that in your situation, just reach out to me and let me know. All right. So let's talk about the milestones for if you're 60 plus. You want to kind of come up with a strategy in terms of when you should anticipate collecting Social Security. Determine what your full retirement age is. It's either going to be 66 or it's going to be, 67. Okay. Calculating your benefits. So let's dive in taxes. Let's dive into what is full retirement. All right. So here's a little chart that I like to show. And like I mentioned before, if you're born before 1960, full retirement is 66. But depending on exactly what year you were born, it could be 66 and 6 months, or at, for example, if you were born in 57, full retirement is 66 and 6 months, et cetera. You get the idea. But if you're born after 1960, full retirement is 67. How do you determine if you're eligible? I mean, if you've worked at least 40 quarters, 10 years, and you've paid into Social Security, it's yours. Okay. And I believe as of late, or recently, there was a new law that was passed. I think it's called the Social Security Fairness Act or something like that, whereby if you were a government employee and you didn't pay into Social Security, you're still entitled to Social Security. So that's a win for folks who, like a sheriff deputy that doesn't pay into Social Security. Looks like you're going to be eligible to also not only collect your ACERA benefits, but also collect Social Security. So I don't know the intimate details of that, but I do recall that act passing. So that's good news for many of you. Okay. How do you calculate benefits? How does that work? Well, they take a 35-year work history, and they take the average of what your salaries were to determine how much you're going to get in Social Security. Now, obviously here, if you didn't work the full 35, say you work 30 years, well, they're going to say 5 of those years you had no income, so it's zero. So because it's zero, that's going to push down your benefits in terms of Social Security. So just keep that in mind. I also have found that the Social Security Administration doesn't always have accurate records in terms of your annual income. So that's another reason why you want to log on to ssa.gov to at least determine how much you're going to get from Social Security, but then also make sure that the income information that's in Social Security is accurate. Okay. Here's when you're calculating benefits. Let's go back. Let's back up here. All right. So if, for example, you were to collect Social Security early at age 62, that's your prerogative, but you're going to get roughly 25% less than what you could have gotten. And it consistently will get worse, but it gets better as you move closer to full retirement. So if you're 62, you're taking a big haircut. But if you can wait to 63 or 64, it's not full retirement, but it's still a little bit more. And it continues to move up until your full retirement, and you'll get the max benefits. And you can also wait until you're 70 to collect Social Security. Now, some of you may be thinking, all right, When is a good time to collect Social Security? Should I collect it at 62? Is that the best place? 67 or 70? And typically that involves your expected life expectancy. Let's be honest here. If, for example, you anticipate living until you're in your 90s, when you do the math, collecting it at age 70 makes the most sense. If you have, God forbid, you have some health issues, you have to retire early, you don't think you're going to be with us all that long, then collecting it early at 62 is best. But as you know, many of us fall right smack dab in the middle, and collecting at full retirement makes the most sense. Okay. Now I will say this. This is my own personal opinion. I've kind of changed my tune when it comes to Social Security. There was a time where I said, you got to wait until full retirement to get your maximum benefit. You're leaving money on the table when you collect it early. And we went through COVID. And unfortunately, a lot of our fellow Americans didn't make it through that process. My family members passed away prematurely because of COVID. So I've determined that life's too short. Tomorrow's not always promised. If you're in a situation, hypothetically, you're 62, you feel like you want to retire, and just ride off into the sunset. You're 62, you do the math on a Sarah, it's really not enough to sustain your lifestyle, just a Sarah. But if you were to collect Social Security, you could retire comfortably and be fine. In that scenario, I say take Social Security at 62, take your Sarah, and enjoy your retirement. Tomorrow's not promised. Yes, are you leaving some money on the table? Absolutely, right? But wouldn't it be unfortunate and sad if you're waiting until 66, 67, and you don't make it? You never got a chance to enjoy your money. So that's my take. But you can listen to my opinion. You can talk to your family members. You can talk to, your local attorney, the attorney you work with, your CPA. They can give you some tidbits in terms of when to collect Social Security. But I just wanted to make sure I expressed, my thoughts surrounding Social Security. Is Social Security taxable? For many of you, it will be taxable. It's pretty much based upon your income for that year. Yes, when you retire, maybe you're not working, but you're still collecting a SARA as your income. So if you're single, you make more than $25,000, a portion of it's going to be taxable. If you're married, you make more than $32,000. Some of it's going to be taxable. Okay, so those are some things you want to keep in mind, but check with your CPA, check with your tax accountant for your own personal situation to know for certain whether or not in your situation Social Security is going to be taxable. 65 is, I'm not going to spend a whole lot of time here, but as many of you are aware, that's when you need to sign up for Medicare. But I would also tell you, if you're still working or if you're about to retire, come up with a withdrawal strategy in terms of, should I take out 4% of my account? Should I take out 3%, 6% of my account every year? When should you take it? And here's where I'm talking about health insurance. Sarah, the last I heard, had a great seminar as it relates to Medicare. So I would encourage you to participate in that. And I would participate in even before you retire, just so you understand the pros and cons of Medicare and the different parts that are associated with Medicare. Okay, let's talk about income. What accounts should you tap first? In my view, when you have all of these different buckets of money, my opinion, you start tapping your money that has already been taxed. So any money that's maybe in a CD or in a brokerage account, trust account under your name that's already been taxed, start there. Then move on to your pre-tax money, your before tax money. And then lastly, tap your tax-free money. That's your Roth money. Okay. Those are the different buckets I would go through as you're creating income for yourself in retirement. If you want some more details or you need some answers with respect to your personal situation, just reach out to me. Even when you retire, there's still risks to your income. There's market volatility. Who knows what the market is going to do when you're retired? So you're going to have to deal with that. Tax strategies. Are you going to be in a higher, lower tax bracket in retirement? You got to, make sure you're making the right decisions there. Low interest rates. If you tend to use CDs as your investment strategy or investment accounts, as you know, as interest rates start to drop, that means your money's not going to earn a whole lot in a CD. So you want to deal with that. Inflation, the cost of goods and services going up over time. If inflation on average runs at 3%, but you're only earning 2% on your money, that means technically you're losing money, losing about 1%. Higher taxes, cost of living ties into inflation, and then you have longevity, right? You just can't assume, all right, I'm going to live until I'm 80, or I'm going to live until, I'm 85. You may make it to 100, right? And so if you're not thoughtful about how you're spending your money, you could potentially run out of money pretty quickly. Okay. Here's a little information on Medicare. It begins at 65. You need to sign up. Part A, Part B. Check with Acera, sit through those seminars to get more information about Medicare. Okay. Let's talk about 70. The new age in terms of required minimum distribution is 73. So at 73, you're required by law to take out your minimum required distribution, which is based upon your life expectancy tables or on the tables. How much is it? It's roughly 4 to 6% of your account balance needs to be taken out. If you don't do that on a timely manner, in a timely fashion, the IRS could hit you with a 50% penalty. So hypothetically, let's say your RMD is supposed to be 20 grand and you neglected to take it out. You could get hit with a penalty of $10,000. So it's you want to make sure you're on top of this. Now, I probably mentioned it earlier, but if you are 73 and you are still working, you have your deferred comp, you don't have to take out your RMD because you're still working. Okay. Now let me repeat that. If you're with the county, you're working at 73, you have deferred comp, you don't have to take money out. So you're good to go. However, if you have a 403B, 401k, you have an IRA outside of the county, then you are subject to the RMD with those accounts. Okay. So I just want to make sure everyone is aware of that. Okay. Now, when the time comes, you're going to get a letter from Empower. You're turning 73. Here's some forms. If you need some help completing the distribution forms, let me know. The other thing I would encourage each and every one of you to do is to make Empower calculate your RMD and send it to you automatically without you having to complete paperwork. Why? Because I have found as you age, if you don't need the money, you may forget. And we all know what'll happen if you forget to take out your RMD. So have Empower calculate it on your behalf and make sure they send it to you. Okay. That's my preferred method. Some people also are probably thinking, well, how much? I know I got to pay taxes. How much will I have to pay in taxes? Are my taxes on this distribution based upon my age? And the answer is age has nothing to do with taxes. It's all about income. How much income did you generate in this year, plus what you're getting in your RMD added together? That's your tax bracket. So it's entirely possible your taxes could go up depending on your income, because I believe with your Acera, you get that cost of living adjustment that gives you a bump 3-4% or even more every year. So that means you're making more, and so you're potentially going to be you're going to have to pay a little bit more in taxes. Okay, so I just wanted to make sure everyone was aware of that, and I talked about the penalty on that. Once you leave county service, what are your distribution options? You can leave the money in the plan, right? My dad used to always say, if it ain't broke, why try to fix it? If deferred comp's been working for you throughout your career, you have the option of leaving your money in the plan. However, if you have a trusted advisor, investment person who appreciates investing in stocks individual stocks, not mutual funds, then that may make sense to roll your money out. Or if you prefer to invest in real estate, you want to move money into a self-directed account and buy real estate, knock yourself out. That is an option. But if you're the type of person that's probably just going to invest in mutual funds, then it may make sense to stay in the plan, because right now the county's plan is about $1.5 billion. So because of the size of the plan, you're a $1 billion client of Empower. So the fee structure, investments, et cetera, are tied to that. Versus if you move money out, say even if you move a million bucks, well, you're still may not get the same types of benefits as you get from deferred comp. So that's just something to keep in mind. So you can create your own portfolio. You can use GoalMaker if you're using it now. GoalMaker is that award-winning program where you tell us what your investor profile is. I'm conservative, moderate, aggressive, the year you're going to retire, and then boom, you're off and running. There is a new managed account program through Fisher Investments that you still have access to even as a retiree. So be thoughtful about those decisions, because if you roll your money out, you can't roll it back in, unfortunately. Now, I believe the manager of deferred comp is trying to change the rule on that, because a lot of participants are trying to come back. But for now, if you roll your money out, you can't roll it back in. Okay. So the end is just the beginning. I mean, you've spent your entire career being responsible, making sure you're putting money away towards your retirement, and that's great. But it's the beginning. It's the end, but it's still the beginning, because you have to be responsible about making sure you don't run out of money, right? And I'm sure many of you aren't going to run out of money. Sometimes I get frustrated with some retirees; they don't spend enough. I mean, in my view, you can responsibly spend 5% of your deferred comp a year. That's okay. 5% will work, but I want you to start spending your money. You've worked too hard. You've sacrificed too much for your family, etc. You should be able to enjoy the fruits of your labor in retirement. So if you want to take that trip to wherever, do it. If you want to buy that car, that brand new car, I know there's quite a few participants I've kind of talked into buying a new car for themselves. Okay. Treat yourself, but be responsible with your money. 5% is a really good number that you can work on. Okay. Excuse me. I got someone calling me. Okay. So with that, I'd love to entertain some questions. Well, real quick, let's see. Sarah, you guys know about that. Let me talk about this, Mike. I completely forgot.
Sure.
If you have time left on the books in terms of vacation, if you don't need the money, I would encourage you put that money into deferred comp. And Mike, did you talk about purchasing a Sarah service credit in your presentation?
Briefly, yeah.
Briefly. Okay, so you briefly touched on that. You can use your deferred comp money to purchase service credits. So I just wanted to make sure I brought that up. And I mentioned AlamedaCountyDCP.com to create a user ID and password. Here are the different financial advisors. Here's the website you can go to schedule an appointment. Here's the telephone number, 855-969-4572. If you want to get a hold of me directly, you can call my office at 510-562-6355, or you can email me at g underscore Hilliard, HILLIARD, at emergefinancial.com. Okay. So with that, now I would love to entertain some questions. So go for it.
Amazing. Thanks so much, Gene.
It's my pleasure.